merge NBCU with Warner, sort of throwing some cold water on the notion that the administration would be rejectful about it.
Where's Faber?
Oh, we need him.
Yeah.
Yeah.
I'm not that close to that company anymore.
Yeah.
It's in Philadelphia.
Wolf comes out today and says CMC SA shareholders should hope Bloomberg's correct, that it would put them in what they call sort of a Disney-like league among American households.
Disney-like league.
Yeah.
Disney's been stuck at 105 for like my life. It's like it's got epoxy to 105. I think it's great because what you need if you own Comcast is to get it out of the 4 to 5 multiple, because that's usually reserved for companies that make hot rolled steel.
And what do you think's behind the Netflix down 5? You think that's part of this?
I feel that they're going to be to a bidding war.
Right.
Wow. Zaz ain't returning calls. I can't help you.
it's not a little busy, as you can imagine.
I can't even get him to have a steak with me since they closed that terrific steak place at Time Warner Center. That was bad.
Jim, really quick on oil. These talks in Moscow, the general take on the tape is that it may be not as constructive as some might have hoped. We're going to approach 60 if we go a little bit further.
I would stay away from oil at all costs.
Some might have
needs inflation to come down, and oil's the keystone. And I think that people should recognize that if the president weren't involved with a bunch of other things today, the phone calls would go to Russia. Look, I'm not saying whether he sells out Ukraine or not, but I'm just saying stay away from oil. The world's awash in oil. It's a wash.
Right.
And a lot of it is because people felt that we weren't going to be able to put any more out. Now, it turned out to be a canard. We're putting out a huge amount of oil. By the way, we're putting out so much natural gas that if you're levered to natural gas and you're not worried every minute about nuclear power, you can see where the data center is going to get their power.
Right. Although nat gas flirting with the 5 handle soon, right?
That has to do with the misallocation of where that gas is versus where it should be, because the Marcellus is pumping like mad, but they don't have enough. Someone's going to say, listen, the reason why it's up is because we're exporting enough, too much, but that's just not the case. It's just very hard to get around because a lot of the important pipelines have been blocked by regulatory, and they have to change. So that price is, I know it's a widowmaker, as I always say, yes. You're shorted,
yes.
But that's an unnaturally high price versus what it could be in terms of what we're pumping.
It's been stubborn. Diesel too. Retail diesel's been a little stubborn too.
But I stay focused on it because that's the heating bill, and the heating bills really matter.
Yeah.
But I know a market that is not being manipulated, but is being. It doesn't run as we'd like.
Right. Market's trying to undo that pre-market jitter. Meantime, we're getting services PMI with Rick Santelli. Morning again, Rick.
Good morning, Carl. These are November final reads. These are S&P Global Services Composite PMIs. ISM at the top of the hour. So the mid-month read of 55 gets downgraded on the services to 54.1. That's the lowest in June and sequentially lower than last month's final read, which was 54.8. And if we look at the composite, 54.2 replaces 54.8, another downgrade, and it's sequentially lower than its final read for October, which was 54.6. So the only positives here are we're in expansion territory over 50, but the reads are deteriorating, and that's not only from a mid-month read, but from a read from last month. We see that interest rates are hovering right now, right around that 406 level in a 10-year. That's down 3 basis points. Much of a parallel shift on the curve. Most maturities are down roughly 3 basis points. We'll have ISM services PMIs at the top of the hour. Squawk on the Street will return after a short break.
Watching shares of Wayfair today, down about 8%. This is going to take you back to the 50-day for the first time since late October. Jefferies does cut to hold today. Jim, some discussion about lack of a top-line update for fiscal Q4.
I'm not too worried there. It's another one if you bet against it, funeral notice, okay?
Definitely.
Just go send it to me. I'll send it to you in advance. I'll email you.
Lock in some gains for the year, you'll understand why.
Wayfair is just a winner. It's a winner because it turned out to be cheaper and just as good. And everybody said over and over again, it's not going to make it. And look how much money you lost if you bet again. It's almost as much money you lost as from the clowns who told you that Apple wasn't doing well.
There were a few of those.
They were mendicants. They were fools. There
were some bulls and there were some bears, Jim. That's how it generally
us to
works.
Sell it short,
yes.
And they too. That's like a mass funeral. It's a St. Valentine's Day massacre for those guys.
Meantime, holding 68.20 or so. Don't go anywhere. Let's get to Jim and stop trading.
Yeah, well, first on the natural gas, we should know that Europe is effectively entered final phase of completely severing ties with Russian natural gas as of today.
Yep.
So that could be a headline risk. The same information article that really savaged Microsoft and made them sound like they have no idea what they're doing. Also says that Salesforce, including ServiceNow, that Salesforce is offering steep discounts to customers to try new agent products. That would indicate that they're going to miss the quarter. Now, again, everyone loves the information. So if you love the information, you think that they're right, then you got to sell Salesforce. I want to hear what Mark Benioff has to say. The stock's down a lot. I've been saying I wish they called it Agent Force, and that way they'd be able to say, look, we are going to be the company you go to when you're CVS and you want to integrate, or Walgreens, whatever, and you want to speak 7 languages and you get a Salesforce AI agent. But I want to see what they say because I read this information and everyone tells me that's next to godliness, and that would mean that Salesforce blows it.
Has there been a story in the information that you think they got completely wrong?
There have been some things that they have said that were very negative about companies that turned out to be doing well. And one of them is NVIDIA. They made sure that the stories appeared during the quiet period, so you couldn't go to
Yes,
Jensen.
we usually
and
talk
ask,
about the timing of some of their
So,
pieces.
like, what are you going to do? I call Jensen, and they say, listen, we can't help you. See, NVIDIA is what I call an honest company. And that means when you call them during the quiet period, not unlike, say, Michael Dell, you call them the quiet period, what happens is you basically, not only do you get talked to the hand, they'll slap you. Because what you have is insolence by me. I don't want to get in the insolent game. I used to do it. It's not that fun. You kicked in the butt. Tonight I've got Snowflake, which has just been up 100 points since they first started coming on the show. And then George Kurtz, and we can find out why it's always been wrong to sell the stock when they report. And it's also, remember, he did win Le Mans. I always like to point that out for no particular reason. But George is a winner, and you can go sell a winner all you want. By the way, what you should be selling are nuclear companies and companies that are doing converts and issuing stock. That's who you sell.
Yes, as you have been monitoring this age of magical investing in your words.
It's over.
Yes.
Joan did in.
Yeah. Jim, we'll see you tonight. Busy day. Mad Money, 6 p.m. Eastern Time. When we come back, the Commerce Secretary, Howard Lutnick. Don't go anywhere.
Good Wednesday morning. Welcome to Squawk on the Street. I'm Sarah Eisen with Carl Quintanilla and Michael Santoli. We are live at Post 9 of the New York Stock Exchange. David Faber has the morning off. We've got a big interview coming up in just a moment. Commerce Secretary Howard Lutnick joins us to talk tariffs, the economy, the Trump administration's latest investment news, and much more. Plus, Evercore's Krishna Guha will be with us to dissect today's weaker jobs number and how it could impact next week's Fed decision. And Microsoft under some pressure right now as the report just out raises concerns about demand for its AI agents. More on that story straight ahead.
Working our way through some services data. Let's get back to Rick Santelli with ISM. Hey, Rick.
Yes, these are ISM PMIs, as you mentioned, Carl. They have no mid-month reads, so these are fresh November reads. A mixed bag here. 52.6 the headline. Better than expectations, sequentially higher than our last look at 52.4, and it's the best number since Feb of this year. And if you look at prices paid, and we'd rather have this go down, well, it is less than expectations. We're looking for 68 plus, comes in at 65.4, much lower than 70 in the rearview mirror. That's the lightest on prices paid since April of this year. New orders, 52.9. Now, here's a bit of the mixed bag. Yes, it's above 50, but it's definitely below last month at 56.2. This will be the weakest since SEP of this year. And finally, on the employment front, on a week we're supposed to get the big jobs report, but we're not going to get it. 48.9. Once again, it's under 50. That's not good, but it is sequentially higher than our last look at 48.2. It's the best since May of this year. If you sum it all up, basically it really is kind of a mixed bag in services. Some good news. The good news here maybe is prices paid moving a bit down. We're hovering right now right around 406.5 in a 10-year. That's down about 3 basis points. Same for a 2-year, down about 3 basis points. Watch the yield curve. It's hovering at 58 plus, near 3-month wide. Sarah, back to you.
Okay, Rick, thank you. Rick Santelli. A number of big headlines on the trade front this week. The U.S. and the U.K. announcing a deal to secure zero tariffs on British pharma products. Meantime, the general tariff rate on imports from South Korea, including autos, drops to 15%, retroactive to November 1st. Let's bring in U.S. Commerce Secretary Howard Lutnick at the center of all of these discussions. Welcome, Mr. Secretary. It's good to have you.
Great to see you.
So before we get into some of these trade negotiations and deals, I do want to ask you about the recent economic data, because today we learned that the private sector is losing jobs. Small business getting hit really hard. Negative number in front of ADP, and one of the reasons that they cite is tariffs. So do you worry about some of the economic fallout here as these tariffs really take hold?
No, it's not tariffs. Remember, you had the Democratic shutdown, right? And what do you think happens to small business? The people who do business with the U.S. government, they know they're not getting paid, so they sort of slow down their projects. So you saw a little bit even of construction of small business down. So the Democratic shutdown hurt the numbers. And then remember, as you deport people, that's going to suppress private job numbers of small businesses. But they'll rebalance and they'll regrow. So I think this is just a near-term event. And you'll see as the numbers come through over the next couple of months, you'll see that all pass. And next year, the numbers are going to be fantastic. I think because the jobs of building in America, you know, as Donald Trump talks about, President Trump talks about the huge construction projects coming to America, I think you're going to see GDP next year superb, over 4%.
I mean, you can definitely point to the shutdown, but we hear all the time that businesses do struggle with tariffs and the higher costs and the uncertainty that comes around that. And even if you don't think that that's happening, I mean, factory activity shrinking in November by the most in 4 months. We got a manufacturing report this week, and in that survey, they did cite tariffs as a reason. I mean, this was a sector that was supposed to be helped the most by what you're doing on the trade front.
Look, tariffs, you know, you're overstating. The fact is, we know, because we've studied it, that prices don't move unless tariffs are above 15%. They just don't move at all, because the suppliers and the distributors eat the numbers, and that's why prices stay the same. You got inflation at the same levels, you know, cut to below 3%. I mean, these are key numbers. You heard prices coming down, energy coming down. It's not tariffs. It's simply a matter of there's idiosyncrasies in October with the shutdown. I think you'll see that pass, and things will go incredibly well next year. I think the huge amount of growth in factories and construction coming next year are going to be impressive. AI building is going to be amazing. We're going to roll out huge amounts of power. We're going to cut the price of power in America, and that's going to also drive the economy.
Yeah, I mean, those higher electricity costs, certainly a big deal. So let's talk about where you are on these trade negotiations. Out of the UK this week, zero tariffs on pharma products. They're going to pay more for drugs. How did that come together, and what's the fine print that investors need to know?
Well, remember the UK was the first deal, and we set out, and the first deal is always the best deal because they're the leader and they came first. So the idea is they're big companies, right? The AstraZeneca, for example, and GSK, they agreed to build in America, number one, and number two, to cut their prices of drugs to Medicaid and Medicare in America. So they did the two key things. So they're big companies, did the two key things, and then we took that deal and made that deal available generally for the UK. They raised their prices they're going to pay for drugs, so that makes it easier for our companies to lower the prices here. And then they're building in America, so this is a 3-year term while they build in America, and that's how it's going to work. That is the sort of the driven model of the Trump administration for pharmaceuticals. Build in America, cut your prices here, and we'll give you a break on tariffs while you do it.
Do you think that could work for Europe, which also, I mean, they manufacture a lot of drugs in places like Ireland? Could we see zero tariffs there as part of those discussions?
Well, I think that's a different, that's a giant deal. Remember, Europe has got 450 million people in a $20 trillion economy. So they've just got to get all of the trade deal that we did in place before we roll on to the next thing. And I was just in Brussels last week, and I was talking to them. They very much want to deal with us. And I said, look, you got to lay off our tech companies. There's a balance. These are trade deals. You got to trade for the best outcomes for America.
Is there any indication that they'll do that? They've been pretty dug in on that, on those technology rules.
Well, I think their technology rules are costing them big time. I mean, you have the investment dollars available for these giant tech companies to build AI in their locations would be amazing if they laid off these rules. And what I tried to tell them is, if you follow Donald Trump's rules, then you're going to get investment the way Donald Trump gets investment, right? $18 trillion committed to America. If you have ridiculous rules, you're going to get ridiculous outcomes. So rethink your outcomes, and so you'll get much more AI development. I mean, that's what I pointed out to the UK, $4 billion of tech investment in the UK. While that sounds nice, it could have been $24 billion if they just had the same kind of rules that President Trump has put in place in America, encouraging development, encouraging building, encouraging growth of AI instead of attacking it like these European economies.
I mean, keep us posted on that. The Europeans love regulation, especially on tech, which we've been covering over recent years. So what's the plan with all of these sort of deals and frameworks, Mr. Secretary? If the Supreme Court does knock down the legality of the reciprocal tariffs?
Well, we're going to win the case. I think I'm confident. I was there. I sat there. I listened to the whole case. I think we win 5-4 or 6-3 because I think the president's absolutely right. He's allowed to regulate importation. That's the rules. He can do it with a fee and a tariff. I think that is perfectly reasonable. However, we have other tools as well, right? We have tons of different rules. Like this building has 232 tariffs, which already went through the Supreme Court, and we won 9-0. So that's autos, that's semiconductors, that's steel and aluminum, that's lumber. So all those stay. So all these big trade deals, I think, are durable, and they will stay. And I think if the unfortunate thing happens, a crazy thing happens where the Supreme Court didn't side with the president, which I think they will, then we have other tools, and we'll put them right in place. Tariffs are here to stay. The deals are here to stay. Everyone should expect this is the way it's going to be. America's going to be richer. Would it be a pain in the tail? Of course it would. But will it change the outcome for America? I think our ability to replace them is okay. I prefer and I expect that the IEEPA tariffs will stay.
I mean, I do wonder if businesses are hedging. I'm sure you noted that Costco became the largest and most high-profile company to sue the administration to get in line for tariff refunds if the Supreme Court doesn't go your way. What's your reaction to that?
Well, look, it's someone getting in line saying, if I'd like some money, I get it, but it's not going to happen. I am confident it's not going to happen, and we will have tariffs no matter what going forward.
What about Taiwan? I know you've been in the middle of negotiating this one too, and we're watching. Of course, it's important with chips, and not all the chip makers pay the tariffs, of course, because they're building plants here. But there is talk about them training U.S. workers to build advanced semiconductors as part of the trade deal. Is that true? And where are you on this?
Well, I'm not going to discuss where we are with the Taiwan deal because we're in the midst of discussions. But the fact is, this administration's goal is to bring semiconductor manufacturing to America, right? When we walked in the door, all there was the CHIPS Act, and that really was just a disaster. It wasn't working. So we reshuffled the deck. We changed the way we did anything. You remember TSMC announced a $100 billion increase in their build in Arizona, up to $165 billion. Micron invested more. Texas Instruments invested more. So we're up to like $300 billion in investment in America. I think when we do a deal with Taiwan, that's even going to be bigger. And of course, they're going to train American workers. The whole objective is to bring the supply chains to America, build semiconductors in America, build pharmaceuticals in America, train Americans to do it, and let's have that supply chain right here in America. That's the entire objective.
Piece in Political this morning, Mr. Secretary, about a potential maybe executive order next year regarding robotics. Can you give viewers a sense as to how far down the runway you're looking on AI?
Well, I think, look, robotics and edge computing, which you think about it is, you've all seen like a modern auto plant, right? When you think about robotics, it's really the arms that do the welding and the arms that do the screwing and those kind of things, like you have an auto plant. This is why America can reshore advanced manufacturing, right? We don't have millions and millions of people to work and do little screwing in things, but we can bring advanced manufacturing here and have 3,000 and 5,000 Americans, doing the technician, doing the air conditioning systems. These are high-tech, incredible technical jobs that pay incredibly well. We're going to train Americans to do this. This is the workforce that's coming. And I think robotics, drone manufacturing, chip manufacturing, pharmaceutical manufacturing, these are going to be the linchpin of American advanced manufacturing going forward.
Yeah, we keep having this conversation with you at this desk. This notion of reshoring manufacturing, driving employment, but also driving automation. Where's the balance? How many workers can legitimately repair or maintain these machines? You understand that tension, right?
I do. Look, a semiconductor plant is a $20 billion automated plant, right? It's a clean room. But there's 4,000 people per $20 billion plant, and they're building 10 of them, TSMC, right? So that's a 30 to 40,000 person jobs. And these are great jobs, but they're technical jobs, right? They're fixing robotics. They're working on air conditioning systems because the room has to be cold and it has to be pristine, right? I met a pipe fitter, and I said, how is it? He goes, this is the greatest game of Tetris ever. I mean, you have to get the pipes in perfect location, in perfect position. And the guy said, this is the greatest job ever that you could ever have. And so the people love their jobs, and these are great American jobs. And we have to train 5 million Americans for these jobs because Donald Trump has brought the investment of $18 trillion. Now we have to train the workforce to do it.
Speaking of advanced manufacturing, X-Lite, this is Pat Gelsinger's next act. It's the latest investment from the U.S., from the administration, from the U.S. government, $150 million. How do these come across your desk, Secretary Lutnick? Because I'm sure there are a lot of startups that are working on game-changing technologies that would like the investment of the U.S. government. So how do you pick the winners here?
Well, the CHIPS Act set a structure of some money to go for advanced manufacturing of semiconductors and some for R&D. And the Biden administration had literally sent out $7.4 billion into some fraudulent company called Natcast, and it was trying to steal the money. We recaptured all the money, and now we can use that money to invest in companies that will advance manufacturing in America. So X-Lite, as an example, is trying to augment the way semiconductors are made, right, and move to the next level. Right now it's called extreme ultraviolet. That's how you paint sort of the chips, the electronic chips, right? Silicon comes in, and then they paint it with extreme ultraviolet light, and that's how you create a chip that goes in your iPhone or an AI chip. So the X-Lite is trying to design the next generation of it and do it with other technologies, and we are always open for that, but we do lots of diligence, we have lots of experts, and we sort of help. If it's going to help America and companies are backing it and behind it, then we're interested in being involved, because we need to make sure America stays at the forefront of technology and chip production.
Yeah, I mean, I know you mentioned at the cabinet meeting yesterday that how much we're up on the Intel investment, which is something that we have covered, and that's good for American taxpayers. But what's the exit strategy with some of these investments, public or private?
Well, generally speaking, the government just wants to make sure they're a winner. They've got the tools necessary. Remember, this is for chip production, right? You know, you have the greatest companies in the world, like Google with their TPU and NVIDIA with their GPU. We're not giving money to those companies. Those are design companies. We're talking about manufacturing in America. We're interested in manufacturing in America, and we're interested in the next generation of power in America, fusion technology, fission technology, right? Nuclear technology. These are the places where we want to make sure America's got the power here. And the exit will be simple. If these companies are successful, they'll go public, or they'll have a round and we'll exit. The exit isn't going to be easy if they're successful. And because we see everything, we can be very choosy. And the American taxpayers, remember, this money was already allocated. We're just doing so much of a better job. When we put out money, we get equity that pays America back. We don't love giving out grants. We love giving out money to companies and getting repaid for the American taxpayer. That's what happens when you put a businessman in the Oval Office. He understands fair balance and making sure the American taxpayer gets the benefit of the bargain.
All right, well, speaking of the market, before we let you go, I always have to ask you for an update on Fannie and Freddie. So when can we expect that IPO? Is it something you can get done by first quarter? Because I think last time you were on a few months ago, you said that it was a sooner rather than later story.
It is a sooner rather than later story. I think that's exactly right. I mean, I would like to see that, but, this is a full administration discussing it, working it through. But we are well down the road on getting a deal done with Fannie and Freddie, and I am excited about its prospects going forward. I think these are great American companies that produce great cash flow, but the key is we want to keep the mortgage rates low for America. The fundamental first driver is let's keep mortgage rates as low as possible. We've got a lot of ideas in the offing, and that's bringing them all together to drive mortgage rates down. Remember, you've got first-time mortgage buyers because of the Biden inflation, 40 years old. That is just broken. When Donald Trump left office, they were 33 years old, the average home buyer. And then because of Biden's inflation, it went up to 40. Donald Trump is on it, and we're going to focus on that kind of opportunity together with the agencies going public. I think we're going to do some amazing things next year.
Q1? Is it a Q1 story?
I'll leave that to the announcement later.
By the way, one way to get mortgage rates, or at least the president thinks to lower, is the Fed. And are you involved in this process of choosing the next Fed chair? Did he ask your opinion?
Of course, he asked my opinion, but he has a really good list. He's narrowed that down really, really, really small, and I think he's got great choices. And I'm excited for the change because Jerome Powell is just political. He's just political, and it's ridiculous, right? Rates should be lower in America. We all know it. They should be lower, and it will make America better to have lower interest rates.
What did you tell him when he asked your advice? Who did you recommend?
He had great names. I know all the people that he was looking for. I had spent time with them all, and I had and I told him what I thought. But that's between me and the president.
All right, fair. I had to ask. Secretary Howard Lutnick, thank you very much for talking us through a lot on your portfolio, from trade to investments to housing. That is the Commerce Secretary of the United States.
When we come back this morning, a potential canary in the coal mine for the AI trade. We'll talk about this report about demand sending Microsoft shares lower this morning.
Plus, Krishna Guha from Evercore will be with us to talk about today's big miss on ADP jobs.
And And Fanatics CEO Michael Rubin making news with us in Las Vegas a couple weeks ago. Remember this on CNBC?
What about the predictions markets? Very hot right now, fast growing. Do you think that there's a risk that they cannibalize sports betting?
Yeah, so first,
Are you going to get in?
I'll give
There's
this
a
to you
report.
first,
Yeah.
right here.
Yeah.
Let's go. I'm giving it to you right
let's
now.
go. We gotta make
We're
some
launching the next couple weeks.
Launching a
Fanatics prediction markets.
market.
Absolutely.
Is this with crypto.com, as rumored?
It is. It is with crypto.com.
All right, we will talk to the CEO of Fanatics Betting and Gaming about this entry into the prediction market. Squawk on the Street will be right back.
Welcome back. Microsoft shares under pressure in early trading near the bottom of the S&P 500 and holding back the NASDAQ after a bearish report around the company's AI software sales. Steve Kovacs here with the details. Hi, Steve.
Hey there, Mike. Yeah, there's some nuance here, so let me explain what's going on. So the information reporting that Microsoft cut sales quotas by about half for this one specific AI product called Foundry. Now, that's a tool businesses can buy from Microsoft so they can kind of build their own artificial intelligence agents and then deploy them across their network. This is saying customers have found that it just doesn't work as right. They can't really get a good return on their investment and so on. So that is why you're seeing the pressure under here. But I would also point out, and this is also pointed out in the piece, and we've heard this from Microsoft just about every earnings report, while the consumer-facing part of AI isn't really growing like gangbusters over at Microsoft, it's the cloud side that they're seeing the real benefit from. That's in large part due to their relationship with OpenAI, which spends billions and billions and billions on Azure for cloud compute. You can see the growth rate right here. You might remember during the pandemic, that growth rate really decelerated and it started accelerating again after this AI moment and all that in capital investments on data centers and the like. But this report also hits something that I've been reporting on for like the last 18 months or so. I talked to CTOs, Microsoft customers, all of these people, and the story they keep coming back at me with is it's just better to kind of build your own AI tools yourself as opposed to use these so-called off-the-shelf products from Microsoft and others. Now, this report isn't talking about Copilot specifically, but I do hear a lot of complaints about Copilot and things like that as well. So this also kind of carries forward, guys, to Salesforce earnings after the bell today. They talk a lot about their Agentforce product, but they're also struggling to sell it too. Carl, I'll send it over to you.
It's a great point, Steve. Kramer's been all over whether or not Salesforce should change their name to Agentforce to emphasize the agents. Steve Kovac, thanks. Still to come this morning, ADP coming in worse than expected, as you might know by now. Evercore's Krishna Guha will join us with his take and what it might mean for the Fed meeting next week. Plus, a key part of the auto market's flashing a warning sign when it comes to the consumer. We'll talk about what has the street concerned. And the read on retail, from AEO's strong earnings beat to some changes at the C-suite over at Nike. Don't go away.
We are about 30 minutes here into the hour. Here are three big retail movers we're watching. American Eagle shares flying higher after a big top and bottom line beat, raising the guidance. The company CEO saying he's encouraged by the impact of collaborations with Sydney Sweeney and Travis Kelce and a new partnership with Martha Stewart as well. Stock's up 14%. It's had a great run. Macy's reversing its pre-market losses after earnings guidance for the holiday quarter fell short of expectations. That said, they did post the strongest same-store sales growth in 13 quarters. And then watching Nike today, the company naming a new COO, a role that hadn't existed at Nike since back in 2023, while also eliminating their chief commercial officer and chief technology officer roles. Guys, what I can tell you is that this is just the latest leg in Elliott Hill, the CEO, who's been there for a little over a year's turnaround plan. It's a turnaround that he said would not be overnight and would take potentially several years. Clearly, they're not slowing down. They're moving forward. Some of these moves that they're making
just try to flatten the organization. And that's what Elliott Hill said in a memo to his team overall. This is a matrix-y organization. I think the other important point here is that there are now no more key hires in top management by John Donahoe, the prior CEO. It's all of Elliott's people. And as you can see, I spent time with him, a few weeks ago at the headquarters talking through the turnaround. Part of it is just making this a faster, more agile and innovative company. And having now the geographies, for instance, which he consolidated into the geographical teams, report directly to him, he feels like makes sense. I mean, Mike, this is a guy who led certain geographies. He led the European market. Right. So having a layer between him and the head of that market just ultimately didn't make sense.
And elevating a supply chain person as COO, right? So
Correct.
That also shows a priority
and also
there.
Giving him the role of head of technology, which I think incorporates technology into every aspect of the business and everything they're doing here. Clearly, it's part of his plan to make things faster and work better at Nike. So yes. And also the chief commercial officer. Now, all that strategy and Nike Direct goes under the CFO, Matt Friend, who has also been in charge of strategy. Friend and Hill have worked together for decades at Nike and clearly, have been working hard to try to get things moving again. There's some green shoots. I mean, we saw it in the last quarter, running, for instance, the U.S. market, but then there are others that are taking longer, like the China market. And Hill has sort of been transparent about the fact that this is going to take a little while.
All right, we do want to get to more breaking news on that Microsoft bit we just told you about. Let's get back to Steve Kovac. Steve.
Hey there, Mike. Yeah, literally as I was on air with you guys, Microsoft, a few minutes ago, Microsoft emailed me. They are kind of knocking back on this information report, saying they cut sales quotas for some AI products. Let me just read you what they told me. They say now the company has not lowered quotas targets for its salespeople. And they also mentioned or pointed out that the information just changed its headline on the story that said they lowered quotas. Now the headline reads, Microsoft lowers AI software growth targets. That is way different than sales quotas. So a little bit of nuance here going on, but the information did correct their headline or change their headline rather based on this new information Microsoft is saying. Microsoft now saying they have not reduced the sales quotas. I'm also expecting Microsoft to come out with some more information of this, but you can see now shares are reacting here a little bit. They were down as much as 2.5% last I looked, now down at more like 1.5%, guys.
I mean, Steve, obviously it's a substantive difference, but also shows you how sensitive the market is to just any slight change of the anticipated pace of growth in these areas and who's relatively in and out and whether we have to downscale our expectations for how quick this stuff pays off.
Precisely. And keep in mind, this was just one little product within the whole suite and portfolio of AI products that sent the shares down 2.5%. It's not even their main product. And again, like I said, when I was on a few minutes ago, the cloud business is doing great and growing like crazy. It's over $100 billion a year business now, in large part due to all this AI spending happening in the cloud. So yes, the market is incredibly sensitive to these kind of headlines, but just this clarification from Microsoft really does seem to be easing some of those fears, Mike.
Does, though, the thesis that there is frustration on some of the leading edge products within the enterprise, Stephen, that remains intact?
Yeah, that's absolutely. There's some questions about that. And again, I'll go back to what I told you last time, Carl, which was I talk to CTOs all the time, and they keep telling me, yeah, Copilot's good for some things, or maybe not, but they also say the outputs are not that great. Basically, the promise doesn't necessarily live up to what these kind of products can deliver, and they're seeing much more success building it themselves, and these kind of bespoke AI chatbots or agents or what have you. But by the way, when they do that, that is still to Microsoft's benefit because they can choose Azure to run all this stuff on Microsoft's cloud. So even if they're not going out there necessarily and buying these products, it doesn't necessarily matter because Microsoft still sees an upside on the cloud side.
It's interesting to see the underperformance of Microsoft. I mean, it's still up almost 15% this year, but underperforming some of the other competitors, certainly in Alphabet.
Oh, for
Thank
sure.
you, Steve.
Sure thing.
Steve Kovac clarifying that Microsoft report, and again, as he said, easing some of the concerns about AI orders. Still ahead, Evercore's Vice Chair Krishna Guha breaking down this morning's rough jobs data. Don't go anywhere.
Welcome back. Some cracks in the labor market as ADP shows the number of badly missed expectations this morning, a loss of 32,000 jobs in November, while the street was looking for a gain of about 40,000. Here to help us break things down is Evercore's Vice Chairman Krishna Guha. Krishna, it's great to have you. Thanks for the help on this one, because the Commerce Secretary did tell us it might be related to the shutdown, but some of these small business cohorts are seeing negative prints, half a dozen months in a row.
Yeah, the small business community is clearly feeling a lot of pain right now. I think there are probably a lot of things going on there. One of them, of course, will be the pressure of tariffs on corporate margins. Much harder for smaller companies to just diversify their suppliers or make their suppliers eat some of those costs. When companies find that their margins are under pressure, they restrain the thing they can control, which is their headcount. More generally, I think, the small business community we know has been under quite a lot of pressure. It's a weak report, 4 out of the last 6 months in aggregate now on ADP, printing negative private sector. And of course, this isn't counting the government layoffs, which would be in the BLS report, because it's just a private sector survey.
Right. So as we go into the new year and we do start talking about tax windfalls, or at least better refunds, and some depreciation schedules that'll be more favorable, can this be unwound, this weakness?
So I do think that the economy is likely to strengthen into next year. I think we will get a significant boost from fiscal in the first half. It might be something of a sugar high, really a powerful impact only on the first 6 months of next year. But during those 6 months, we think that you'll get about a 0.5 point of GDP boost to annualized GDP growth in the first half of next year. That's not nothing. I think you've also got some other reasons to think that the growth outlook will look better. You've got gradual fading of the uncertainty around Trump tariffs, ongoing strong AI-related capex. So I do think things can firm up some into next year. I would expect the labor side, though, to still stay relatively muted.
And if that's the case, Krishna, then how does that filter into what the Fed's going to do next year, and perhaps what it ought to do after we get this cut, presumably next week?
Right. So in the very near term, I think this negative ADP print might temper just a little bit at the margins the hawkish side of the hawkish cut we expect to get next week. Now, when we say hawkish cut, what we mean is they'll deliver the cut with near certainty, but Powell will indicate that they've now completed the series of preemptive risk insurance cuts that they flagged back in September, and that from here policy will be data dependent, but in a more traditional way. That if the data is worse than expected in a material way, then they would cut, but not otherwise. I think they'll just temper that message just a little bit in light of this weakness. It could also mean that you get maybe one less dissent, right, than you would have gotten otherwise. It's the kind of number that might get Sue Collins, for instance, from Boston, on board with voting for a cut. Now, as we look into next year, I think the message will still be that the Powell Fed does not anticipate cutting again in January or March, or indeed likely for the balance of Powell's tenure. It will take some worse data to deliver that next cut. Don't expect the next cut will be preemptive. The next cut, if it happens before June and the new chair, will be a bad news cut.
Yeah, I guess it just depends what happens with that unemployment rate and the job growth.
Sure.
Krishna, does your policy outlook, your rate path outlook, change based on who gets the top job to replace Powell?
So, I think it changes a little bit from, depending on who out of the advertised shortlist gets the gig. But I think we anticipate that almost by construction, whoever's chosen is going to be from the dovish side. In particular, is going to be a supply side dove. And so Kevin Hassett, for instance, in pole position, according to all the reporting, Hassett is somebody who believes that Trump tax cuts, Trump deregulation, plus the AI technology shock is going to allow you to run nominal GDP higher without overheating the economy. He's going to favor more rate cuts next year. So we're going to get next week the SEP, the old committee, the Powell committee, is going to pencil in one cut for next year. I think Hassett, probably the others, but let's say Hassett, would put down in his own mind 3 or 4 cuts next year. What you're going to get is going to be essentially a negotiated compromise between the new chair and the old committee, based on my economic outlook, where I do think we'll get some ongoing growth labor divergence given AI, I think we'll get 2, possibly 3 cuts as they split the difference.
It's going to be an interesting personal dynamic to watch as the new whoever it is moves in. Krishna, going to be an exciting week next week. Thanks so much. Krishna,
For sure. Great to see you.
All right, time now for a CNBC News update. Christina Partsinevelos has that for us. Good morning, Christina.
Good morning, Mike. Well, federal agents launched an immigration crackdown today in New Orleans. A Homeland Security official says the operation will target violent criminals. It's not clear, though, how many agents have been deployed into the city. It comes after similar immigration operations happened in Los Angeles, Chicago, Charlotte, and North Carolina. President Trump's pick to lead NASA, billionaire Jared Isaacman, is testifying right now on Capitol Hill before the Senate Committee on Commerce, Science, and Transportation. Isaacman, an ally of Elon Musk, was originally picked for the role back in May, but the president withdrew his nomination, citing, quote, past associations. He was renominated just last month. And Taylor Swift is no longer Spotify's most streamed artist globally. Hopefully she can shake that off. Puerto Rican superstar Bad Bunny is back on top after a 2-year hiatus, winning the title for the 4th time. Spotify dropped its annual overview of listening trends today, known as Spotify Wrapped, which you may start to see shared everywhere. In the United States alone, Swift still captured the top spot, followed by Drake, Morgan Wallen, Kendrick Lamar, and of course, Bad Bunny. Sarah, back to you.
Think she'll be okay. Thank you, Christina.
Thank you.
Still ahead, executives from Ford, GM, and Stellantis reportedly headed to the Oval Office today for a big announcement around fuel standards. We've got the details next. Plus, sports giant Fanatics diving into a new market, the predictions market. Their CEO of betting and gaming joins us on the news. We're back in just a moment.
With Tesla nearing a $1.5 trillion market cap, some are questioning whether the company is overvalued. We will talk to one strategist who is short Tesla. He'll tell us how far that he thinks the stock will fall in 2026. Tune in to our Market Navigator segment today on Power Lunch. That's at 2 p.m. Eastern.
Welcome back to Squawk on the Street. Executives from America's biggest automakers headed to the White House for a big announcement on some fuel standards today. For that, we're going to turn to our Phil LeBeau, who's with some details. Hey, Phil.
Hey, Carl, the president is expected to announce far lower fuel economy requirements for vehicles made here in the United States. Just for a point of refreshment, the previous standards announced by the Biden administration, I should say current standards, calls for 51 miles per gallon for a fleet-wide average for all the vehicles manufactured by a company by 2031. That's not going to be what we hear from the president today. He's going to be dialing this back considerably. We're still waiting exact numbers in terms of what the fuel economy standard will be, but the expectation is that you will see miles per gallon requirements come down dramatically from where they are right now. And then with that, they will also be easing regulations. That's been a big push from the Trump administration, telling automakers, we'll pull back on the regulations. That will help you on the cost front. Then there's the question of what happens to EVs? Funny that this is coming out on a day where Mary Barra, the CEO of General Motors, is currently talking with Andrew Ross Sorkin at the Deal Book Conference in New York City. He has been talking with her about EVs and specifically whether General Motors pivoted too hard into EVs and now has to reverse course. We're going to be listening to this to see if she has any commentary about the fuel economy standards before she goes down to Washington. At least that's our expectation, along with the CEOs of the other automakers. They're expected to be in the Oval Office at 2:30 this afternoon. Take a look at shares of the automakers and keep in mind that when you look at internal combustion engine vehicle sales in this country, it's about 80%. There was a big surge in EV sales towards the at the end of the third quarter. That has moderated. Hybrids are about 13% of the market. So what you're looking at is the fuel economy standards will be announced this afternoon. One other note, guys, and this data came out this morning. We highlighted it on Squawk Box. The auto loan data coming from Experian, analyzing millions of loans in the third quarter. Average amount borrowed is close to a record high, now over $42,000, up $1,300 compared to Q3 of last year. And average monthly payment, $748, up $13 compared to last year. Sarah, I'll send it back to you.
Okay, thank you. A lot of good information. Thank you, Phil LeBeau. Now to some news around the prediction markets. CNBC can exclusively report that Fanatics is launching Fanatics Markets in partnership with Crypto.com beginning today. The app will go live in 10 states today and in 24 by the end of the week. CEO Michael Rubin teased that announcement with us a couple weeks ago in Vegas. And joining us now is Matt King. He is the CEO of Fanatics Betting and Gaming. Of course, our Contessa Brewer, who covers the space.
Yes, I mean, it's an exciting day for Fanatics because you're launching in about 10 states.
Correct.
Smaller states where you don't already operate the sports book.
That's correct.
What's the calculus?
So the calculus is like any product rollout. How do you start in states where it's smaller? There's some room for error because obviously we've tested the app, but it's going live for the first time. So really the intention over the next 72 hours is basically to be in 24 states.
You're the first sports book actually to launch prediction markets. We know that DraftKings and FanDuel intend to do so. FanDuel said a couple weeks ago it would be in December, but you're beating them to the punch. Have you lost first mover status to Kalshi and Polymarket by not getting there ahead of time?
No, I don't think so. I mean, this is really the top of the first inning on a market that's going to grow exponentially over the next 5 to 10 years. And so we're not worried about being a couple months behind them.
When we talk about the real opportunities, it's probably in the biggest states in the nation, California and Texas, that don't have sports betting. And right now, Hard Rock and the Seminole Tribe have a monopoly on sports betting in Florida. Prediction Markets offers a way into Florida that doesn't currently exist. Talk to me a little bit about what you think that means for the business of Fanatics Betting.
So for us, the way we think about it is, what do fans want to do? Why did we get into prediction markets? We got into prediction markets primarily because when you talk to sports fans, this is one of the things that they're most interested in experiencing, and we know that they want to do it from Fanatics. So for us, this was just a logical extension in terms of something new that sports fans want to have access to.
Is this a regulated market?
It is a regulated market.
By CFTC?
By CFTC.
So, I mean, do they go after things like insider trading?
They absolutely do. It's the same as insider trading in the stock market. It's frankly a federal crime if you trade on insider information. So it is absolutely regulated the same way that other large financial markets are.
Matt, you seem to think, obviously, this is an exploding area in terms of demand, and there's going to be room for lots. But is there any company that you can say, or do you believe you have an edge aside from you have a customer base and a brand? Or I mean, what's going to determine winning and losing as a prediction markets venue?
All of these types of products all come down to the product offering and the customer proposition. We think we can deliver the best in the industry, and that is a combination of brand, the app itself, how do you provide rewards around that, and really kind of holistically present that to the customer. And as you've seen in our sportsbook business as well as our iGaming business, where we're the fastest growing, we can take what Fanatics has to offer and turn it into something that's really compelling for customers.
Is the margin structure much different in prediction versus sportsbook?
It is very different in the sense of, on a kind of dollar of contract volume, your revenue margin is a lot lower, but your gross margins are a lot higher. And so, because you have less cost to run the business.
Less cost?
Yeah.
And that's because?
It's because when you work through kind of all of the different fees and everything else that go into running a regulated sports book, it's just a different cost structure relative to what we do day in,
legacy
day out.
business.
Yeah.
Kalshi just raised $1 billion, some new investors like Kathy Wood's ARK, and now the valuation has more than doubled to $11 billion. Is there a trajectory that you can apply to the Fanatics business because of predictions based on those valuations?
We're not focused on short-term valuations. What we're focused on is, how do I build a big, profitable business long-term over the next 10 years? And so our focus is the same thing as it's always been, which is, how do you develop the best customer proposition possible? And then ultimately, how do you be a top player in the market?
Thank you very much for joining us. There's still a lot of regulatory backlash. The Southern District has issued a class action lawsuit against Kalshi for duping customers. This is not a settled thing on the sports side of it, but the prediction part of it and the urge to bet even on cultural issues or politics, I think, is real.
For sure.
Or what's going to be said on a conference call.
Yeah, right, exactly.
Thanks. Good to see you.
Good to see you.
Key test for the AI trade when CRM reports in just a few hours. We'll talk about what to watch for after the bell tonight when Money Movers begins in a few moments.
Good Wednesday morning. Welcome to Money Movers. I'm Sarah Eisen with Carl Quintanilla live from Post 9 of the New York Stock Exchange. Today, the flashing AI warning signs. Microsoft pushing back on reports of lower AI software demand. NVIDIA seeking to defend its AI moat. And we are joined by a former OpenAI senior executive as the company reportedly declares a code red.
Watching energy today, nat gas above 5 for the first time in a few years, continuing to rise. Kramer calls it unnaturally high as it got close and did achieve that 5 handle. We're joined by the CEO of Williams later on today, the nat gas giant.
And Redfin forecasting what it's calling a great housing reset next year. We're joined by its CEO to discuss the state of the market and the real estate consumer.
Bit of a limited range in stocks today, although the Dow's up almost 200. We're holding 6840 or so. Most sectors are green with the exception of some information technology. The Microsoft scare market's still shaking off. VIX below 17.
We'll start with this morning's weaker than expected ADP data led by small business job cuts, something we asked the Commerce Secretary about, Howard Lutnick, last hour. Listen.
No, it's not tariffs. Remember, you had the Democratic shutdown, right? And what do you think happens to small business? The people who do business with the U.S. government, they know they're not getting paid, so they sort of slow down their projects. So you saw a little bit even of construction of small business down. So the Democratic shutdown hurt the numbers. And then remember, as you deport people, that's going to suppress private job numbers of small businesses. But they'll rebalance and they'll regrow. So I think this is just a near-term event. And you'll see as the numbers come through over the next couple of months, you'll see that all pass.
For more, let's bring in CNBC senior economics reporter Steve Leisman, who has more on this morning's numbers, Steve, and what the outlook looks like.
You know, Sarah, the problem for the Commerce Secretary's explanation is this, and we'll see it in a second on a graphic, but the downturn in small business hiring in the ADP data long predates the shutdown. But first, as Sarah said, a big miss on ADP with the payroll company saying private payrolls declined by 32,000 in November, the fourth negative number in the past 6 months for this series. Total private payrolls down 32,000. Estimate was for 40,000. And you can see goods sector getting hit and the service sector both getting hit. But the big story here, as Sarah also suggested, small business down 120,000. Medium and large size businesses doing okay, up 39,000, 51,000 for medium and 39,000 for large business. Now take a look. Virtually all of the job losses are from the small business side, 1 to 49 employees. They have been negative in 6 of the 7 months going back to April. Before April, they were routinely positive. Without those job losses, overall job growth would have been positive. So these numbers have been lousy since the tariffs were put in place. Causation, correlation, I don't know. Take a look at by sector here. Education, healthcare, and leisure hospitality both doing well. But manufacturing off in a big way. Information and professional business services also off as well. Other data confirms the struggles of small business hiring. There's a company called Homebase that we follow. They're a payroll company as well. They say hours worked fell 3.1%, one of the largest pullbacks in recent years, a result of businesses heading into the holiday season with a reduced workforce and actually actively reducing that headcount ahead of the holiday season. What's it all mean for the Fed? The weak jobs data confirms market expectations for that rate cut, up near 90%, Sarah, as you know, going into the December meeting next week.
Yeah, I do think one question is whether it sways some of the non-cutters, like a Susan Collins that we saw going into the meeting, to have a weak number like this. But Steve, you know, I think, you know, maybe it's having trouble adapting to tariffs on small business, but there actually are quite a few headwinds that have been with us for the last few months. I think one thing we have to mention is small business also tricky with, you know, tighter credit conditions and higher interest rates. I mean, that has been a running theme that we've seen in recent years with small business as well.
No doubt. I think there are other headwinds out there. And I don't think the secretary is totally wrong. Deportations, immigration also playing a role. The shutdown might have played a role, though I doubt it was extensive and national as a result, maybe playing on optimism or the sense of optimism out there for business. I think that's an important factor. But I really think that, and I've been talking about this for a long time, Sarah, it's not hard to imagine that small business has a much tougher time dealing with not only just the tariffs, but the incredible changing tariff landscape on almost a daily or weekly basis, much more difficult than large businesses have. They can't adapt. They don't have a department that says, let's get it from Vietnam instead of Indonesia. Large businesses can do that.
True.
Small businesses take the price that's been given to them. So I think the secretary ought to have an open mind for the possibility that tariffs are playing a role here and think about some relief for small business in this regard.
Well, that brings us to IEPA and a SCOTUS decision, and both the Treasury Secretary and the Commerce Secretary saying today that they can recreate that exact structure if the decision goes against them, which in itself would create incremental uncertainty, Steve.
I mean, there's a reason why, Carl, that we follow a thing called the Economic Uncertainty Index, and it is very elevated, and there's good data that shows that there is an economic impact of elevated uncertainty. I had advocated from the very beginning, Carl, for what it's worth, which I guess is not a whole lot, that the president ought to run these tariffs through Congress. And running them through Congress, and I just talked about this at the CFO Council, running them through Congress creates the stability that businesses need to know these things are in place. Tell me something. Are you going to sit there and break ground right now on domestic production, not knowing if the tariffs that were supposed to protect your domestic production will be in place next month or next year or in the next administration? If you run it through Congress, whatever your thoughts are on tariffs, you get the stability that businesses need to figure out how to invest.
Yeah, but then you might not get it passed, I think is part of the concern
well, if
here.
the peoples don't want it, the people shouldn't get it. That's what the House is for, right? It's the people's house.
Steve, thanks. Really getting into the nitty-gritty on tariff theory. Steve Leisman at the CFO Council today. Staying on the market, our next guest expects the S&P to contract to 6350 over the next several months. Joining us this morning is Stifel's Chief Equity Strategist, Barry Bannister. Barry, it's good to have you back. Good morning.
Hi.
You've had I would argue, sort of sense of caution throughout this year at least, which hasn't necessarily paid off, but you're sticking with it.
Well, I kind of feel like the lemming in the comic book strip where it says the lemming stands up and says, "Wait a minute, what are we doing here?" There is an awful lot of ebullience in the market. The pullback call initially was it didn't look like the Fed was going to cut as much, but then to the day, November 21st, that New York Fed President Williams said, "Yeah, we're going to cut." We took the odds back up, and that reduced the near-term pressure in the market that we had seen after October. Right now, I think the bigger concern is at what point does the market, with this poor data that we're seeing, start wondering if the Fed is too late?
So does the downside get led by the riskiest parts of the markets, which arguably are already in the process of correcting?
Yeah, I mean, clearly the more cyclical side of the S&P 500, and I would include tech and cyclical. I mean, it's a big discussion, but the whole economy now is acting like a tech stock. It's high-end consumers from wealth effects, it's data center construction. We're a hostage to a tech stock. And, I've done this a while. I know that technology is great, but it's a bet the farm, winner take all industry. And to model a whole economy on that is going to introduce a whole new level of risk on top of what Steve was talking about on policy. So for me, it's just a concern about the economy. We're seeing unemployment is most definitely going up. It'll probably go close to the 5% post 1955 70-year median of 5%. And when that happens, consumers will pull back, and that's 68% of the economy. It will affect big tech and their core businesses, which is advertising.
But I guess, part of the bet is, Barry, that technology can help make up for it, whether it's capital spending, whether it's productivity wins, higher growth, all of that offsets maybe a weakening labor market and some of the policy uncertainty. That's been the story of the year.
There was an old movie called Field of Dreams, and the line from the movie was, build it, the baseball field, build it, and they will come. That's what I think AI has been. They don't really have products, and they're spending almost half as much as the United States spends each year on entire residential construction market. So that's a lot of money. To crunch the data with semis and to move the data around with cloud services is not a product. A product will be the software that comes out of the AI, and I don't know if they've got the moats or the core monopoly business big tech margins on that product. So this is the first time in history we've spent this much money not knowing for sure what the demand picture would look like.
Right. I know you're also, if we're going to talk about the promise of AI productivity, that some action in, say, gold, best performing asset of the year, might argue the other direction.
Yeah, we it works in 10 years. It worked on 125 years. If you look at the ratio of oil to gold, it lines up perfectly with productivity growth. Productivity is output per hour worked, how many units you make of anything in 1 hour of time. And it lines up. So you'd have to believe to be long oil, short gold, to believe in an AI-driven productivity story. But either gold tanks or oil goes up on strong global growth. If that happens, it's inflationary. Just overlay CPI against the price of oil. It's not a good thing. So we're at the lowest point since the Great Depression on the oil to gold ratio, the lowest point since the early 1930s. So something's got to give here.
Meanwhile, if you're right about the direction of the indices, where would you imagine the bargains come from? If you got a weakened consumer, can you rely on defensives?
It's funny because we've really paid up in the market for the tech growth promise story. The non-tech cyclicals are probably based on these PMI readings and what's going on in China. There's very little stimulus there, and it takes them 8 months before their stimulus even pays off for global purchasing manager index cyclical measures to work out. So non-tech cyclicals, it looks too early. Tech looks very extended. So that just leaves you on a pullback with defensives, and that's what would probably hold its value in any sort of a pullback. Now, as we go into next year with earnings growth, provided there's no recession or near recession, you could see earnings growth with PE compression, the market multiple comes down, and you could make a case for up market. But at this point, I think we're in a digestion phase for the market. All the news that's come in, the earnings that are expected, the hope, the dream on AI. I think we're going to have to digest these levels for a while.
Right. Well, we've talked a bit about sort of the challenges of midterm years on the markets, and certainly there's no shortage of aggressive targets for year-end 26, Barry. We'll stay in touch. Good to see you again.
Hi, man. Good to see you, Carl.
That one stands out. It's more sour. After the break, Michael Dell weighing in on what he sees as the biggest concern in the AI build-out. Those comments next.
CEO of Williams is with us, handling a third of all nat gas in this country, with prices now at the highest level since 22. Talk about how AI is impacting that outlook when Money Movers continues.
Folks,
Welcome back. Michael Dell making huge news yesterday, announcing he is donating more than $6 billion to fund Trump accounts for millions of kids. I spoke with him yesterday afternoon, where we also discussed, of course, the AI investment cycle and some of these bubble concerns. Listen.
If you think about the $114 trillion economy that we have, roughly 2/3 of the economy is based on knowledge work or services. And if that knowledge work and services can be improved and made more efficient and more productive by, let's say, 5%, the amount that's being invested in AI could actually be not enough. And at least I can tell you from our business, when we talk to the neo clouds and the sovereign AI opportunities, and certainly the growing demand from enterprises as they begin to deploy AI, there's a tremendous amount of demand out there, and I think it will continue.
So you're not worried. You're not worried about the bubble concerns, the competition that's emerging, the code red for open AI. This is all the latest market fixation.
There will be lots of companies playing in this space. I would tell you the big concern right now is that there's actually not enough capacity in the advanced node semiconductors and the other components that we need based on the demand that we see. It looks to us like 2026 will be a year where there is more demand than there is supply.
Joining us now, global AI advisor and former OpenAI head of go-to-market, Zach Cass. Zach is also the author of The Next Renaissance, which will be released in mid-January. It's great to have you. Contrary to market concerns lately, Zach, Michael Dell is saying the problem is there won't be enough spending. There might not be enough investment, not enough capacity. The market's sort of questioning the opposite right now. Where do you think it stands?
Well, I'm pretty willing to. I'm not going to argue with Michael Dell on a lot of these issues. I think, first of all, I totally agree that I think that we don't actually have the infrastructure that we will need to deploy the AI systems that we want, and I think it's actually going to be an energy constraint. Like this, it seems glaringly obvious if you stare at this even for an hour, that the rate limiter is going to be energy. We thought we needed 40% more energy at the beginning of the decade. Now we think we need 1,000% more energy. Where does it come from? We need a step function improvement. And when you talk about the constraints, I actually think it's not necessarily semiconductors. It is the power supply. But I agree that we are probably going to want more of this than we are currently building for.
So talk a little bit about what you did at OpenAI and when you left and why you left.
My job was to help build sales solutions and partnerships. I was one of the early employees and one of the first business hires, and had the incredible privilege of sort of helping the world graduate from its understanding of GPT-3 to then GPT-4, and then, of course, 4.5 and on, and got to grow the company from millions to billions in revenue. And went home actually to Santa Barbara because I'd been talking for so long about the future of abundance and the importance of physical community, and woke up one day and realized I actually wanted to build a life in my hometown, which is the greatest place on earth.
So when you see a report like yesterday's that Sam Altman is declaring code red over the next model as competition heats up, what does that mean to you?
Well, again, I cannot confirm that this announcement, although it seems like the Wall Street Journal has. What I think is important to remember right now is that we are sort of now measuring OpenAI on a lot of axes. And to the company's unending credit, it is basically attacking a hardware space. It's attacking data centers, core models, agents and tooling, hardware, the consumer app, of course, search, and maybe, it's rumored, eventually advertising. That gives a lot of space. And anytime we build these companies up, we see sort of space start to seed, companies can get pretty nervous. I think what's important to remember is that OpenAI has done so much incredible work, and it has incredible expectations for itself. frankly, Gemini 3 is an incredible product, and it's a reminder that the market is just improving a ton right now. And I think that's a pretty exciting trend for the average consumer.
But there is this question around where OpenAI ultimately will sit against the competitors that are spending more but are more profitable and already have huge enterprise cloud businesses and sort of are going at the same rate, if not faster, on the models for AI.
Well, Sarah, I agree that the competition landscape is massive. I also agree that Google is the 800-pound gorilla. I'm not sure that I agree that it is obviously outperforming OpenAI, and I think this is where my disagreement with sort of the average person who points at this issue comes in, which is that ChatGPT I still think is a better product, but it also is going to continue to get better. What I think, Jim Cramer, I like Jim a lot, yesterday said, when is OpenAI going to admit that it's falling behind? There is a very good chance that OpenAI releases a better model than the Gemini 3 model that exists today very soon. And at that point, then the market is going to respond and say, oh, look, my favorite team is ahead. My point, I think, right now is that we're spending too much time actually trying to watch this play out like a basketball game, teams trading buckets. And actually I think there's an importance to zooming out here a little, because everyone knows that second quarter, just because your team went on a 6-point run doesn't really mean anything.
No, that makes sense, and you're right. There's been a lot of lead changes in this quarter, but I think the bigger story is that one team appears to be playing all of their starters with not much of a bench, and some of these other players have multiple benches. Isn't that a concern?
Well, yeah. I was trying to think of a good basketball retort. Look, I mean, again, the world's best talent wants to work in this field, and you're sort of splitting hairs when you talk about the actual talent benches that exist inside of companies like OpenAI and Google. Again, it's true. Google has a lot more money. I'm not sure that makes anything better. OpenAI proved when it was just 90 people that it could launch GPT-3, which changed the world in many ways, and ChatGPT with less than 200 employees. So I don't think that number of players on the bench, if we're going to continue this analogy, is the important thing. Focus matters, research breakthroughs matter, enterprise motion matters, and what I think is still true, and Michael Dell pointed this out, we're seeing enterprises flood the zone right now. I think demand is still scratching the surface on a lot of these things, especially, by the way, in fields like healthcare and financial services, where I think we're going to actually see major adoption over the next 2 years.
If this internal memo is correct, and this notion of sort of pushing back advertising or pushing back devices in favor of refining the model, do you think that's wise, given there's so much concern about long-term profitability?
I'm not a corporate strategist, so it is very hard for me to actually make an assessment. Here's what I would say. I think it is very true that there will need to be more money introduced into the space on a multiple basis. And if you are going to build infrastructure, if you're going to build your own chips, if you're going to build your own hardware, if you're going to build your own applications, and OpenAI is signaling that it is doing these things, it doesn't want to lose a lot of ground on anything. But it also has to make some pretty serious bets. And what I can say is it's a company that is very good at delivering when it is very focused. And right now, I think that there's like a pretty good argument that there are some things that it should focus on.
But don't you think when it comes to the competition on enterprise, it is, a story of winners and losers? Because and does OpenAI have a competitive chance there when Google and Microsoft and Amazon are so enshrined in the enterprise software business already?
Well, look, before Google, there was someone else. There is change happens. I try to remember and remind everyone to zoom out a little. A lot of the companies that we're talking about as 800-pound gorillas did not exist until very recently, and actually very recently. I remember on maybe not your segment, but a similar segment, everyone saying, "Oh, Google's done," right? Google fell behind in the AI race. It's too late. Search. They'll have to kill search in order to do anything.
Just a few months ago.
So my point is look. Right now, I'm super happy to be here to talk about this, but I do want to remind everyone that there are serious issues that I think should be addressed. One is the infrastructure that we're going to need, chips and compute, or chips and power. One is policy decisions that we need to start making right now, and frankly, that I don't know that we're sort of thinking about and talking about well enough. But the trading baskets, look, I am super, super excited for all the companies in the category right now, because I do think we are just not even beginning to appreciate how much demand there will be for this. In the same way that I think we didn't know how much demand there would be for the internet or modern compute or frankly, electricity.
Yeah, I mean, echoing Dell there at the top. Well, Zach, it was really good to talk to you and very valuable to hear your perspective. Zach Katz.
Thanks, Sarah. Thanks, Carl.
Thank you.
When we come back, Microsoft pushing back on some of these reports about a slowdown in AI software sales, but competition does remain a concern. We'll talk about that next.
Plus, CEO of Redfin is with us. New mortgage app data released this morning. How rates are impacting demand. Stay with us.
Microsoft shares under some pressure, but off of the lows of the day after reporting from our own Steve Kovac. Microsoft pushing back on these reports that has lowered its AI software sales targets. Company out with a new statement a few moments ago saying the information story inaccurately combines the concepts of growth and sales quotas, which shows their lack of understanding of the way a sales organization works and is compensated. Aggregate sales quotas for AI products have not been lowered as we informed them prior to publication. The information updating its headline to say instead that it's lowering its software growth targets. Meantime, we're getting some fresh data from Ramp on enterprise AI spending and what it might mean for the so-called agent economy. And for that, we'll turn to Deirdre Bosa and today's Tech Check. Hey, Dee.
Hey, morning, Carl. So what the data shows is that this isn't just a Microsoft story. This may be a reset moment for the agent economy at large. Even Sam Altman, in his internal code red memo that we've been talking about, he said that OpenAI will shift resources away from agents to fix the core ChatGPT experience. So you have two of the biggest AI players tempering expectations around these new agent products, or put simply, workflow automation. Now, that new data from Ramp, it shows, however, that Anthropic just saw one of its biggest monthly gains in AI enterprise adoption, while OpenAI, still the leader, is seeing its growth moderate. But it isn't chatbots or agents for Anthropic. The data says that the real growth is in API spend. So put another way, guys, agents are top down. They're sold to executives. APIs, they're bottom up, adopted by the builders at these organizations. And that is a key distinction because enterprise agents, they may be hitting friction, but usage as a whole is not, and that is where Anthropic is winning. Now, it raises big questions for Microsoft. Did it bet too heavily on one partner? It spent the last few years building its enterprise AI story around OpenAI, but the fastest growing enterprise model today is Anthropic's Claude, and Microsoft knows it. Last month, the company announced it will invest up to $5 billion in Anthropic, really a clear move to reduce its dependence on OpenAI and cover its bases in a multi-model future. It's worth pointing out Amazon got there first. AWS has been Anthropic's primary cloud and training partner for years. And with enterprise adoption accelerating, according to that data, that early bet is looking more and more strategic. So, guys, the bottom line for investors, that early hype around agents was hype, but the real money right now is in model usage. That doesn't mean that agents won't get there, but they may be proving more complicated to deploy at scale than people appreciate it. I had one person in tech tell me that it's not the year of the agent, it's the decade of the agent. So that could imply investors may have to wait a little longer to see that ROI.
And how does it work with the companies? I mean, how competitive is it really? We were just having this conversation with someone who worked at OpenAI, but are these companies using multiple agents and multiple companies, like an Anthropic and an OpenAI and a Microsoft? Can they employ them all, or is it just one versus the other, whichever has the better model right now?
Yeah, I mean, you hear often that kind of enterprises are model agnostic. They'll use the one that best serves their purposes, but what I hear is that in a lot of those cases, it ends up being Claude. You know, enterprises, developers, Claude seems to be gaining. And also, it may lead to profitability sooner, right? When you have this dynamic of when will or won't OpenAI and Anthropic go public? Could they IPO around a similar timing? Obviously, the profits piece is going to be extremely important. I think it was a journal report not too long ago saying that this enterprise adoption and the popularity of Claude may actually help Anthropic get there sooner.
Dee, really interesting, and this little drama by the information definitely added to the color today. That's our Deirdre Bosa. Let's get a news update with Christina Partsinevelos. Hi, Christina.
Hi, Carl. President Trump today pardoned Texas Democratic Congressman Henry Cooler and his wife, who are charged in a federal bribery and conspiracy case. In a post on Truth Social, Mr. Trump cited a weaponized justice system, claiming Cooler was being prosecuted because he was critical of former President Biden's immigration policies. Switching gears completely, Google announced today that it will comply with the world's first teen social media ban in Australia, and they're going to lock out YouTube users who are under the age of 16. Facebook, Instagram, TikTok, and Snap have already said they would also comply. The law bans platforms from allowing kids under 16 to have accounts and is closely watched in other countries considering similar bans. And Hyundai will start selling a four-wheeled robot powered by artificial intelligence next year. The mobile electric droid, that's what it's being called, is the automaker's first mass-produced mobility product. It's essentially a platform with wheels that you're seeing on your screen, but Hyundai says it could potentially be used for everything from deliveries to filmmaking. Keyword could. Sarah?
Okay. More automakers getting into robots. Thank you, Christina. Still to come, natural gas at its highest level since 2022, with colder forecasts lifting prices here. We'll get to the impact from AI power demand as well, with the CEO of Williams handling a third of all natural gas in the United States. That's next. Welcome back. Take a look at natural gas topping $5 for the first time in 3 years as colder temperatures set in across the U.S. Between the weather and then the growing power needs for AIs, where should you expect prices to go in 2026? Joining us is Williams CEO Chad Zamarin. The company delivers roughly a third of all natural gas in the United States with more than 30,000 miles of pipelines. So do you expect these higher prices to stay, Chad?
Yeah, thanks for having me, Sarah. We are entering the highest demand time of the year for natural gas. And so we have seen gas prices, get to $5 per MMBTU. We don't expect that to last, long beyond the winter time. And in fact, forward markets are showing that we likely see gas prices come back down into a range of $4 to $5. It is important to note that still at $4 to $5 natural gas on an energy equivalent basis is about 50 to 60 cents per gallon of gasoline on an energy equivalent basis. So it's still our most affordable energy resource we have here in the United States. But we do see the winter, colder than maybe normal, going to drive some additional demand this winter. But we should see prices stay in a moderate range over the long term.
I was just going to ask, how does demand look overall into 2026?
Yeah, demand is strong. I mean, we have ramped natural gas. We've grown demand in the United States by 60% over the last 15 years. That's a lot of demand growth for a very large sector of energy in our country. And now we see LNG exports continue to ramp up through the end of the decade. And importantly, we're seeing AI and the race for build out of data centers and data center capacity. It's going to have to largely lean on natural gas as the most dispatchable, reliable, and clean energy resource we have that we can bring to scale quickly. And so we're going to continue to see a lot of important, strong demand for natural gas.
Chad, if demand is so strong, why would we be looking for much relief on price, even once we get past the seasonals?
Yeah, I mean, Carl, the great reality is we've got a tremendous amount of supply in the United States. The challenge when it comes to price is not having the ability to produce low-cost supply. It really is having the infrastructure in place. And I know I heard one of your prior guests talk about the constraints for the build-out of AI. And it's not an energy supply issue. It truly is an infrastructure issue. It's our ability to get energy produced affordably, but then get it delivered to where and when it's needed. That's really the challenge here in the U.S. I'm here in Washington, D.C. Congress is working on permitting reform. That's one of the most important things Congress could do for our country from both an affordability perspective and from an AI reaching our full potential perspective is pass meaningful permitting reform so we can build the infrastructure we need to bring energy supplies to markets that need them.
We've seen, we're monitoring pretty well the horse race of energy suppliers for the next 5 to 10 years. And I'm wondering if you've seen any kind of degradation in the argument for, say, nuclear, whereas given the immediate availability of nat gas.
Yeah, I think the reality is we need to be exploring every possible energy solution we can. I've mentioned before, we haven't grown electricity production in the United States in 25 years. I mean, that is a shocking statistic. In 25 years, we haven't grown electricity production. Over that same time period, we know China has grown almost 10 times their electricity production. They now dwarf us from the perspective of producing electrons. And when we talk about the next generation of technology and opportunity, we're going to need to get back to growing our electricity production capabilities here in the United States. And so we're going to need to explore all technologies. But the reality is we don't see nuclear playing a meaningful role in the next 5 to 10 years. We're going to have to lean on natural gas as the most dispatchable, also the most affordable resource that we have. And so I think over the long term, nuclear, I hope, will play a meaningful part. But certainly as we look to the next 5 to 10 years, we're going to have to lean into natural gas in a big way.
So how much is AI empowering those data centers is driving your business right now? How big of a part of it, and how big does it get?
Yeah, it's pretty meaningful. When you think about natural gas demand growth in the U.S., right now we do have a large LNG export ramp that's happening, which is good. That way we can supply American-made energy to our friends and allies around the world. Important to remember that we were able to double LNG imports into Europe when Russia invaded Ukraine. So that's very important. But for AI, we've got to scale power, and the fastest way to scale power in the U.S. is with natural gas infrastructure. The challenge is expanding the grid is a very slow and cumbersome process. So in many cases, we are building projects both to expand our networks and grow the grid over time. Those are going to take 3, 5, 6 to 10 years in some cases. So we're also taking projects that bring natural gas directly to data centers. We can put power on site, doesn't burden the consumer. We can bring excess power over time, ideally even lower cost for consumers, but make sure data centers can scale up. We've got several projects across our footprint where we're doing that.
All right, Chad, thank you for the update. It was good to talk to you.
You too. Thanks, Sarah. Thanks, Carl.
Chad Zamarin, the CEO of Williams.
CEO of Redfin's coming up after the break. We just got some new mortgage app data this morning with mortgage rates moving a little bit lower in the past week, although still some challenges on that front. Stay with us. Welcome back. Prospective home buyers getting some relief as new data shows mortgage rates did tick lower last week, with affordability a major focus nationwide. Our next guest predicts that 2026 will be the year of the, quote, great housing reset. And joining us this morning is Redfin CEO Glenn Kelman. Glenn, we are always grateful for your insight. Good to see you again.
Great to be here.
So what brings about the reset? It sounds like you think the idea that incomes grow faster than home prices is kind of important.
It is. The housing market has been going down for 3 or 4 years straight. 2026 is going to be the year that things start to get better. It's not going to be some overnight sensation, but it will be an improvement where home prices grow 1% and wages grow 3 or 4%. That means that housing will get slightly more affordable. And that's good news because America needs a break. Housing
Right.
prices have been going up, even as sales have been going down.
It doesn't sound, though, like you think the 30-year fixed gets much lower than 6.
It could dip below 6, but just averaging around 6.3, which is what we predict for 2026, will be a material improvement from 2025. We've been stuck at 6.6 for most of the year. So if we can just stay where we are now, or maybe go a little lower, we'll take it.
What the administration is clearly very focused on housing affordability. Commerce Secretary Lutnick addressed it in our interview this morning. They want to see lower mortgage rates. They want to see more supply of homes. I mean, both theoretically would help. Glenn, what do you think is the best policy? What can they do to get the market moving here?
The simplest policy change we could make is to make it easier to build housing. And this is an issue that unites Elizabeth Warren on the left and Donald Trump on the right. You can't find many other issues like that. For the longest time, Americans have been divided about whether we want more home construction because, of course, homeowners worry about how it will affect their prices. But now I think the country has got the bit between its teeth, and we are going to build significantly more housing. It won't solve the problem overnight. No one can. But it is the beginning of a new consensus around affordability. And I think what's interesting about it is that it isn't just home prices anymore. It's utility bills because AI data centers are competing for electricity. And it's also home insurance rates because climate-related natural disasters have made it very expensive to live in the West, very expensive to live in flood-prone areas like Florida. So we are seeing people look at more than just the home price when deciding, can I afford to live here?
A couple questions on multifamily, Glenn. We have had apartment rents decline month on month for 4 straight months. The multifamily vacancy rate's at 7, pretty high. But I'm not sure you think apartment rent relief is going to last.
Yeah, that ain't going to last. So the people building apartments have really slowed down construction, and that means that as supply dwindles and demand remains steady, we should see rents increase. For the longest time, there was an apartment building boom, not in the for sale market, but in the rental market, and that really kept a lid on rents. We are seeing more millennials and Gen Z folks living with their parents, shacking up with roomies. Homeownership rates are very low, so that has suppressed rent increases, but it can't last forever.
Yeah, and driven up the age of first-time home buyers. Glenn, I just wanted to ask you about our colleague Diana Olick's article she put on CNBC.com that got a lot of attention, citing your data on delistings. 85,000 U.S. sellers taking their homes off the market in September, up almost 30% from the year before, and the highest for that month in 8 years. What does that tell you about the market? What are we seeing there?
Never question Diana Olick. She has been on this beat forever. She knows everything. And in this case, she's citing us. So how could I disagree? It's an 8-year high. We see some sellers panicking where they see really good listings that aren't selling. Their own home is getting marketed like crazy and still not moving. And so it's normal at this time of year to delist properties and try again in January or February. But even accounting for that seasonality, it is an 8-year high. And that is just because the market is in transition. So buyers are looking forward 6 months, saying, if I wait, time is going to be on my side. I'm going to get a better deal. And sellers are looking back 6 months, thinking, I wish I'd sold at the beginning of this year instead of being stuck at the bitter end. And so it's a real tough time in the market. There's always a reset coming into the next year. I don't think the rate decreases have affected the housing market because they came too late in the season. But if we start next year with a rate closer to 6.0, we are going to see more home sales. It's just almost a law of physics.
Yeah. Interesting. Spring is going to be important, Glenn. Really good insight and information, as always. We appreciate it. Good to see you.
One more prediction. Peace and love in 2026. It's going to be so good next year.
Oh, that's good. We'll take that one, Glenn.
Peace and love and a housing reset. That is so Glenn Kelman. Thank you. When we come back, a big test for Salesforce and its AI strategy. When it reports later today, the stock's been an underperformer this year, down around 30%.
Plus, Palantir's Alex Karp on stage at DealBook this hour. You'll hear what he had to say on China competition in the AI race.
our primary and most important adversary, I say adversary consciously and not enemy, is China. And we will decide, AI and the ability to implement it on the battlefield primarily will decide the values, i.e., the norms, the laws, and the spirit of the laws that are imposed upon us across the globe. And if you think for a minute they believe anything that we're being taught in our idiotic faculty, you are even more idiotic than the professors teaching it. And I'll tell you, if you actually believe in these values, again, I'm not a neocon, I never was. That's why I'm skeptical of immigration, because I don't think all this cultural assimilation hasn't worked in the last 50 years, and that's an obvious truth you're also not allowed to say. I'm skeptical of imposing values on other people. I never believed we should or try to make the Arab Middle East, Wilsonian people, like a Wilsonian ideal imposed upon them. If you believe for a second that anyone else outside this country believes that we are going to defend our values without superiority and moral violence, you're just living in a world that doesn't exist. It does not exist.
All right, all of Karp's sort of worldview is wrapped into that one soundbite. It was Palantir, of course, founder and CEO Alex Karp on stage at DealBook with our Andrew Ross Sorkin earlier this hour, talking quite a bit about the relationship between the U.S. and other countries. We'll bring you all the highlights from DealBook throughout the day here on CNBC.
Yeah, it's been a busy morning for Andrew, that's for sure. Meantime, Salesforce looking to change the narrative around its AI strategy tonight when it reports results, and Seema Modi's got a curtain raiser on that. Hey, Seema.
Sarah, CEO Mark Benioff has been championing this idea, right, that Salesforce's AI agents can automate tasks, make businesses more efficient, and in some cases replace human talent. And while the company has had a number of early customer wins like Williams-Sonoma, FedEx, investors tonight want more concrete evidence of adoption, examples of how businesses are integrating these agents. Citi analyst Tyler Radke spoke to 3 Salesforce partners recently, and he walked away with what he calls cautious feedback, noting smaller initial commitments from customers, limited anecdotes of Agentforce use cases. Beyond AI, there are a lot of competitors trying to steal market share from Salesforce's core software business like Monday.com, ZoomInfo, even Snowflake. Gil Luria at D.A. Davidson says he'll be looking for clues as to how Benioff is navigating this threat. And guys, there's also some chatter about whether Benioff's recent social media post in which he praised Google's Gemini 3 is a preview of some sort of type of deal or partnership in the works between Google and Salesforce. So we'll keep an eye on that and more.
Yeah, it's kind of become a benchmark of a barometer of how the market feels about some of these software stocks on the software versus AI trade. Seema,
Right.
Thank you.
Plus, it was probably the most unadulterated endorsement of Gemini that we've had so far.
Yeah,
when he said,
Mark,
I'm not going back.
He's also, though, endorsed Grok in the past and Musk and those models. So, I mean, he clearly has his finger on the pulse of what's happening and who's leading on technology. It will be interesting to see if they start to announce some deals, in other words, powering their Einstein AI agent.
Yeah, obviously markets got just hair trigger response given Microsoft's example today on the heels that it reported the information. Yeah, absolutely. Holding on to 68.35, Dominic Chu in for the judge.
All right, thanks very much, Carl. Thank you, Carl. Thank you, Sarah. Welcome to the Halftime Report. I am Dominic Chu in for Scott Wapner today. Front and center this hour, the setup for stocks into the year end. The investment committee is standing by with their playbooks. So joining me for the hour are Joe Terranova, Stephanie Link, Jim Lebenthal, and Bryn Talkington. So let's get a quick check on the markets right now as things stand. It's a relatively calm one. The Dow's up about 0.5% to 47,686. The S&P 500 holding on to that 6,800 level, 68.36 the last trade there, just about 0.1% gain there. And the Nasdaq Composite just about flat, drifting between marginal gains and losses at this point. The Russell 2000 Small Cap Index up a blistering 1% in this market here. We're going to have more on that in just a moment, but first we're going to kick things off with a big committee move. This is Bryn throwing in the towel, so to speak, on Salesforce ahead of the earnings report after the closing bell today. You're not even going to wait to see what happens. Bryn, why are you getting out?
Yeah, well, so I mentioned this on Monday. I've been in this stock for a minute, probably a quarter and a half. And I feel like when the market goes up, it doesn't go up. When the market goes down, it goes down slightly. I feel they're going to have very solid numbers, good free cash flow. We'll hear about some of their new customers. But ultimately, what makes a stock go higher? There's more buyers than sellers. And I feel that Salesforce right now, from a stock perspective, is stuck in the mud. And so I just don't think that we're going to hear tonight anything revelatory that's happening. I just feel like it's a moment in time, and people are not wanting to, put more capital in this name. So I didn't want to sit through earnings in case the market has a negative feedback, which it's done on a bunch of stocks that actually had good numbers. So I just, I wanted to sell before the earnings call tonight.
All right, Bryn, so an interesting move here to not wait for any kind of validation one way or the other. I mean, you could be right about this or you could be wrong about it. But Jim Lebenthal, maybe I'll go to you about this first. If you were an investor like Bryn, we just heard got the sales call in there for Salesforce, what exactly would make you as an investor want to get out ahead of understanding maybe what could be a catalyzing factor to the upside for a stock like Salesforce, even though it has underperformed? Maybe it gets a pop because something does get said that reinforces that positive narrative.
Well, Dom, first off, let me say I completely understand Bryn's point of view. I really do. I mean, it's like, why fight this hard for a stock? And as much as I'm asking that rhetorically, I'm asking it myself with a very similar stock, Adobe, which we'll report next week. But whatever Salesforce does in the after hours and tomorrow will probably be echoed by Adobe as well. And basically what we have here, and I'm staying with it for now, and the reason that I'm doing it is because there is a strong disconnect between the operational results at Adobe and how the share price responds. Now, I think Bryn phrased it excellently, more sellers than buyers. That's been the case with both of these stocks and many in the software space. But what I have found, just being a long-term investor over periods of time, there are periods of times where the fundamentals disconnect from the share price, and if you believe the fundamentals are going to stay intact, which I do, then you'd want to be there for the rebound. I don't have a strong opinion on what Salesforce is going to do tonight because I don't know the name as well as Adobe, but they're both facing the same seemingly existential threat from artificial intelligence, both in terms of usurping the business and reducing the number of seats that actually use those products. But to date, it just hasn't happened. It shows up that the results are better than expected. It's what I expect will be in both names.
Bryn, how do you respond? You just heard Jim's thought about this. Exactly. I mean, does he have it right? I guess is the point.
Yeah, I mean, I think we're both right here. I think he's frustrated with Adobe for similar reasons. But I will say one thing on Salesforce, what I thought was peculiar. So I could be wrong, but I believe OpenAI powers Einstein. And so I thought that was very peculiar that Mark Benioff goes and tweets about Gemini when I believe Salesforce works with OpenAI. So to me, I felt like that was bizarre. And maybe they shifted that, but I know originally Einstein, I believe, was powered by like the ChatGPT version. And so to me, that was also peculiar and another sign of like, well, aren't you supporting the underlying technology that's supposed to be working using all these agents? I just think at the end of the day, what's given me direction is the stock price. I don't need to wait to get confirmation. The market is telling me it's not doing anything, by the way. I hope they have great numbers and it's up 20%. That's great. Right. But I mean, to me, the stock price is telling me what's happening.
I agree with you. We both may be right, and you haven't been in it for long. So I actually applaud you for getting out and not being, stuck with it. I will say for somebody like me with Adobe who is in it and staying in it, you're reminded of what happened to Salesforce in 2022 and then the rebound into 2023, which was pretty gigantic. And this isn't at Bryn. This is just for everybody who's watching that sometimes we stick with these stocks where the fundamentals are better than the share price would otherwise say because the rebound is imminent.
All right, Joe, what do you think?
Based on the strategy that I utilize to take positions in the market, I'm on Team Bryn for this one. While I'm speaking, if you could show up a 52-week chart of the IGV, which is software, you're going to see it's basically flat. It's unchanged over the last 52 weeks. The other side of that, pull up the SMH. That's up probably somewhere, if I'm correct, around 45 to 46%. So, yes, we own software names in the ETF. We've been reducing our holdings throughout 2025. The remaining names that we have, they don't look good, except maybe a Palantir, which is pulled back. We have Workday. We have ServiceNow, we have Fortinet, we have DocuSign. They're all underperforming. You could cite a variety of different reasons. There was clearly, coming into the second half of the year, questions surrounding software valuations. Did software valuations reach an extreme? And secondarily, there is the constant chatter from the Trump administration surrounding restrictions on exports of products, technology products, that are using U.S. software. And that has had a negative effect on all of these software names, in particular in the current quarter.
Well, it's interesting as well because you can use momentum as a proxy for sentiment, and that kind of makes the point that you and Bryn are both making about this. Speaking of one of those names that's momentum tied, it's another cloud name. And Stephanie, I'm going to go to you for this one because Snowflake is also on deck coming up here. So let's talk a little bit about the setup here. We're up 1.5% on the shares going into this particular print so far today. What is there to like or not like or anticipate from Snowflake?
Yeah, and I would just start by saying this company has growth, real growth, product revenue growth of 29 to 30%. They probably have to beat it for the stock to do well because the stock's up 70% on the year. But they're in the right part of software. Whereas I would say that Salesforce and Adobe are expensive for the growth that you're getting. So Snowflake is expensive, don't get me wrong, and I'm nervous about it. However, as I mentioned, they not only have the growth, but they also have the operating margin opportunity. Last year at this time, it was low single digits operating margins. They could do 9-10% operating margins this quarter. I think the whisper might even be a little bit higher, but I see a trajectory of them getting to mid-teens. And so I think you're going to, if you have the top line and you got the margins, you're going to get the operating leverage on the bottom line. All of this being said, Dom, they actually pre-announced on October 27th. So I really don't think they're going to have that much in terms of new news. But to the extent that they could surprise us on the margin side or surprise us on the product revenue side, I'll feel good about it. But this is one name that I think is a very big beneficiary from all of the data that has been created and needs to be cleaned for the companies in data centers and in AI to work.
You've done a great job with Snowflake, hands down.
Well,
and
not easy.
Well, that's exactly what I wanted to say, is because there was a point in time, basically a 3-year period, where it was just stuck. And you stuck with it because you had the conviction, you did the work, you did the analysis.
Thanks, Chuck.
Frankly, that's what I see in Adobe. I may well be wrong, all right? I'm not, and everybody listening, I'm not right all the time. We all know that. This business of predicting the future has error in it. All that said, Adobe at 15 times earnings, it's got a 14% projected growth rate, which it has exceeded over the past few years. Buying back shares, very clean balance sheet. I'm comfortable with the valuation.
It's cheaper than Salesforce, and it has a little bit better growth. But, I mean, I just think that there's other technology names in general that are more attractive that have better growth.
So speaking of, another one of those attractive technology names that has seen its fair share of lumps, bumps, and even rallies has been in cyber in particular. We're talking about CrowdStrike. All right, and on CrowdStrike, I want to show the shares right now because what we are seeing, at least in reaction to the report, is what happened with earnings and its projections. This is a stock that's down fractionally. When I was on Worldwide Exchange earlier this morning, it was down maybe 1% to 2%. Yeah. This was a trifecta. Beat on earnings, beat on revenue, guidance is better than expected and raised. Why? Because it was already up 25% in 3 months. Again, what exactly is it about CrowdStrike, Stephanie, maybe, that makes this particular stock one that is worth either maintaining or initiating any kind of a position if it pulls back even more markedly?
Well, I don't think I would initiate a position, Don, with the stock up 50%. The expectations are very high. It trades at about 30 times price to sales. If you want to be in cybersecurity, you could certainly own this one. They're the best. They are absolutely the best, but I think they're priced to be the best, as they should. They have been delivering after that horrible snafu that they had with Microsoft 1.5 years ago. They've really fixed. They have great management. The guidance for fiscal 27 is for net new annualized recurring revenue to be 20%, operating margins to be about 24%, free cash flow margins to be 30%. That is best in show, best in class. The one I own bigger and the one I have been buying and I recommend to buy here is Palo Alto, because that stock is only up 3% year to date. And I think a lot of that has to do with Joe and I've talked about it because we both own it, because they've done 2 acquisitions, almost valued at $30 billion in 4 months' time. And I think people are nervous about the integration risk. If there's any management that can get this thing done, it's this management team. And in the meantime, they have a whole slew of products. And the reason why we're seeing M&A and what I think we're going to do and we're going to see over the next several years, the M&A is going to happen. We have 4,000 companies in cybersecurity, both public and private. And I think the bigger companies are going to get bigger and bigger. This is what Palo Alto is doing. They're doing it because they don't offer everything for their clients, and their clients want them to. So you talk to CTOs and they'll say, we want to use 4, 5, 6 vendors, not 20 vendors. Well, if that's the case, you're going to see the big 5 continuing to make acquisitions. And I think that's positive for the long term.
All right, Joe, you either personally and or the Joe T ETF own both of those names in Palo Alto Networks and in CrowdStrike. So take us through what your thesis is for both of them and why you want to stay long.
The investments thesis surrounding cybersecurity has been a very strong one for the last several years. And I'll also mention that we own Okta and Fortinet, and I'm not happy owning either. And I think that in the case of Okta, which is actually recovering today, I still don't think that it is establishing itself in terms of technical and fundamental momentum and capturing market share. To me, it's about Palo Alto and it's about CrowdStrike. And Steph is spot on. The street is concerned that Palo Alto is becoming a serial acquirer. I'm not necessarily sure in cybersecurity that's such a bad thing, because the deals that they have done with CyberArk and Chronosphere are actually good deals. I think CrowdStrike pulled back already because of that. This quarter that they reported was fantastic. Steph already cited that. Annual recurring revenue was up 23% in this quarter, and new net annual recurring revenue was up 73% in the quarter. So they beat on revenue by 20 million. I think CrowdStrike is well positioned. They have diversified products, and I think it really is now narrowing the opportunity in cybersecurity to these two specific names.
Bryn, there are people who pick the stocks like CrowdStrike, like Palo Alto, Okta, and others. And then there are those who use the ETFs and some of the kind of thematic elements for this. You are one of those people who takes a thematic approach to cyber. So we know kind of what the macro secular tailwinds are. Why do you want to stay long cyber?
Well, I think you just said it, the secular tailwinds, the growth. When you think about AI, when we think about as technology continues to innovate, cybersecurity is just going to continue to get a bigger and bigger spend. I like the bug, the ETF specifically, versus the other cybersecurities, because it's fully focused on cybersecurity. Like the top holdings are 6%, 5%, and 6%. So I get Palo Alto, I get all of those companies. I also get the losers as well, but I think that longer term, this is just an area that I will continue to add to. So I just think it's one of those areas. We talk about software, we talk about all sorts of different sectors. Cybersecurity will continue to grow, I think, well above earnings of the S&P, just because corporations across sectors are just going to continue to have to spend more and more.
All right, we've talked about a lot of big names, but there are not that many that are bigger than our next one. So let's talk a little Microsoft, struggling to rebound following a report by The Information that brought the shares lower. Our Steve Kovac has all the details of the back and forth and responses and whatnot. Steve, what can you tell us?
Yeah, it's a lot of whiplash going on here. So let me try to break it down as simply as I can. So Dom, that information report you alluded to, it originally published this morning saying that Microsoft had cut quotas for its one AI product called Foundry. That's something that lets companies build their own AI agents. Then Microsoft came back about an hour or an hour and a half later, and they told me, whoa, we did not cut quotas for this product. The information got it wrong. I'll just read you their statement here, saying the information story inaccurately combines the concepts of growth and sales quota, which shows their lack of understanding of the way a sales organization works and is compensated. And they reiterate, aggregate sales quotas for AI products have not been lowered. And so that is basically their position here, is there's maybe some of the growth targets aren't really meeting where they want to go. But as far as the quotas go, which is a very different thing, those were not cut. So we saw shares down as much as 2.5% on this. They've eased back down now about 1.8%. And just some things to think about this, though, Dom. Yes, they're pushing back on this one story, but we do hear so often in my reporting over the last 18 months or so since Microsoft started selling these AI products, CTOs and customers tell me all the time that they would often prefer to build their own instead of go buy off the shelf from a Salesforce or from a Microsoft and things like that. So anecdotally, we see some of the stuff in that information report actually happening. But as far as the nugget or the meat of that, the protein of that report, Microsoft is pushing back on that in a very specific way. I would also note that this really translates to what you guys were talking about earlier on Salesforce, and we're going to hear that after the bell today, that this idea that they're having trouble getting agent force out there. This is where Microsoft benefits, though, guys, because they have the whole cloud system running everything behind it. So even if customers aren't necessarily buying these off-the-shelf AI products, they have the cloud business that's growing quite strongly. I'm showing you here on the back of OpenAI activity and the back of all this other AI activity happening within their cloud business. You can't say that Salesforce has the same thing, Dom.
Okay, Steve Kovac, thank you for laying out exactly kind of what happened with the back and forth with Microsoft and those sales quotas versus AI products and everything else. Stephanie, I'm going to go to you with this one first. Yeah. Steve makes an interesting point. Microsoft, there probably is no better, I guess, example of a hyperscaler that has combined a portfolio of products that gives it the scale to be able to compete effectively in just about every product category. Microsoft, though, will take a hit when it sees headlines like this because investor sentiment is focused, to your point, on growth.
Sure.
So where exactly is that kind of line of demarcation where you say scale is good to a certain point, but I want small growth versus that big hyperscale portfolio?
Yeah, and I think you have to dig a little bit into Microsoft to see some of the growth that's not appreciated. Because I recently added this position. I hadn't been involved. It is now down 11% since they reported earnings. They had commercial bookings, Dom, up 111%. They had RPOs up 51%. Azure, 39%. People were all upset that they grew 39% because the Whisper was 40 or 41, and that is ridiculous for a company of this size. There's the growth. And then not only that, they had operating margin expansion of 240 basis points year over year and beat expectations by 240 basis points year over year. So to me, all of that added up with the stock down, I know it's a crowded name, but I just think that that's the opportunity. I'm kind of not paying attention to the 12% total revenue growth.
This is an easy one to talk about because everyone owns it. I mean, if you're benchmarking against the S&P, you own it. So
yeah, you do. But I guess the question I would have for you, Steph, is: are you paying attention to the reaction of both Microsoft and SoftBank since Gemini 3 really has taken control of the headlines? Because both Microsoft and SoftBank are trading lower as that proxy for what we believe the public valuation of OpenAI might be.
Well, I mean, I think that there are certainly questions for sure, but I think any given point, the Mag 7 take a pause on a lot of various different concerns. But I care more about the ecosystem at large at this company, and they are participating in the fast growth of AI, and I don't think it's really appreciated. I mean, the multiple is contracted 5 multiple points from its average.
You know, this is the same conversation we could have had 9 to 18 months ago for Alphabet in terms of underperforming and not showing the same kinds of growth. Yet now, Alphabet has assumed that mantle, the standard bearer of that kind of AI trade. We heard all about the code red comments from Sam Altman at OpenAI. Jim, Alphabet, the mean reversion has played out. Microsoft, some would argue, is there a mean reversion at play in the initial stages?
I mean, I want to agree with what you're saying, but there's a degree of difference here, right? Microsoft is at roughly 28 times forward earnings. Alphabet, when it got down to the bottom, was what, 16 times, something like that? I mean, Alphabet and Meta, Steph, I know it's a name of yours, were at this really kind of cheaper than the market multiple, whereas Microsoft is still more expensive than the market overall. Now, I own it. I'm fine with it. It's a slightly lower than market average position, but I will tell you at this multiple, I'm not inclined to add to it. I'm not inclined to get big in it. If this stock goes below 25, say, as a forward multiple, then I get more interested in Microsoft. It's not just the AI. Obviously, there's the whole operating system business that underlies most of global corporations. So there are reasons to own it, but I'm not just rushing out to purchase it.
To your point, I'm only 3% weighted in Microsoft, and it's 6% of the bench.
It's hard to get excited.
But you can get more excited legging down, because I don't know what the bottom is going to be.
But right now, it looks like it's going down.
It could
I mean, this chart doesn't look good.
I tend to do that, right? I buy as the stocks go down. That's what I'm doing with Meta, so as you pointed out.
Because let's start with this right now, because I want to talk about another stock that is a brand name, household name in technology that has been legging lower since recent highs. And I mean pretty recent. We're talking about Oracle. I want to highlight this right now because Oracle this morning was initiated at an overweight or buy rating over at Wells Fargo with a $280 target price. AI-led reacceleration presents room to run. We see Oracle emerging as a leader in the AI super cycle, right? Super cycle. I've heard that term before. So Oracle is one name. Jim, I'm going to go to you with this one first. You are an owner of Oracle, a name that is now trading at a discount from the highs that we saw just a couple months ago. Is this a name that you want to add to on weakness?
Well, I made it my final trade yesterday, so hopefully that action answers the question. It is, however, a battleground stock, Dom. I mean, we all know that. Today, there's who upgraded it today?
Wells Fargo initiated overweight.
Yesterday, somebody downgraded it. And it's all about the same question. Are they spending too much on hard assets? And this goes to the question of whether the multiple, roughly around 27 times forward earnings, is too high or too cheap. It's certainly cheap relative to some of the other hyperscalers, but they've got all of these data centers that they're building, and the debt that they're using to financing is a concern. So here's the thing. They're reporting next week. I am looking to see if management has heard what the market is telling them and maybe slows down the spending just a little bit, maybe make sure that the free cash flow conversion is higher than expectations. I think that in particular could put a floor to the stock. If management shows, listen, don't worry, we're converting this to free cash flow. We know what we're doing. It's Larry Ellison's company. He knows what he's doing.
Joe, does it bother you? And Jim mentioned the debt that's being undertaken to kind of finance a lot of the expansion in CapEx here. We know that credit default swaps, the insurance on corporate debt is rising to higher levels for Oracle in particular. Is that a worrisome sign or something that you're willing to overlook given the massive amount of tailwinds that AI could produce in the coming years?
Well, I think what it does mechanically is it introduces a process of hedging into the market. So those that participated in the September debt offering, which was, I think, $18 billion investment grade paper for Oracle, they're on the other side hedging that out through the CDS market. Now, Oracle has talked about a private structure deal that's going to be probably twice as large as that investment grade debt offering in September. So, you know, with a debt to equity ratio of 500+% for what we do, and we respect and value debt to equity in our formula for quality, I'm not sure that the expiration date for Oracle in the ETF is going to be extended very long. We'll see what happens in the next rebalance, but I think it's a rightful concern. I will say this, though. If you are not long Oracle and you are looking for a place to get in, Jimmy, you and I talked about this last week. It looks like last Tuesday, November 25th, was a kind of a seminal moment for the market and for Oracle. You've got a low that day somewhere around 185. You could probably, if you're not in, establish a low, a position there with a low risk point of reference at 185.
All right, Bryn, you have not been really active in the Oracle kind of trade so far. Is this something that you feel attracted to, given the fact that we've seen this leg lower over the course of the past couple of months?
No, I mean, I think we're in this stage where, I mean, we all say, well, this is Larry Ellison's company, so that's probably worth, that's a huge amount of currency and credibility that he has. But I think, like, they just don't have the money. And so this is the one company, when you talk about a super cycle, well, yeah, they're going to win the race because they've gone negative free cash flow. And if you listen to everybody, everyone says we're early innings. Well, I think to Satya Nadella's term about a lot of these companies are going to suffer from the winner's dilemma. They spend all this money to try to be first mover advantage, but guess what? Some other person comes in later, doesn't have to spend all the money, and you don't have a moat. And so I'm very unclear about how Oracle is going to pull this off. And so I think the earnings call, I think it's next Wednesday, is going to be a must listen. I think especially in the Q&A, they're obviously going to try to, you know, massage the analysts to not be concerned. But I just think, how do you actually pull this off and not just destroy the balance sheet in the meantime? Because you can't just do SPVs all for the next 5 years. And so to me, still, it's a very dicey name.
There are those out there who, for sure, Bryn, to your point, are waiting for a possible hypothetical revaluation of that AI trade to see how those things shake out. All right, big conversation. We're going to leave it there for right now because up next, the retail roundup is coming with the holiday shopping season in full swing. The committee's ready with their playbooks. Halftime is back in 2 minutes. right, welcome back to the Halftime Report. Retail stocks are higher today after strong guidance from American Eagle, Macy's, Dollar Tree, but new data suggests the holiday shopping season may be off to a more tepid start. So let's take a little bit of a pause here and talk about the season, the all-important one for the retailers. Maybe I'll start with you, Jim, on the retail roundup that we are seeing. There are some very volatile names, and there are ones that are performing not as we would expect post-earnings report. What exactly is your take on all of that?
Well, let me start with the macro. There are questions that are as yet unanswered as to the health of the consumer. We know the consumer got hit hard during the shutdown, and some of the statistics at a macro level that we're seeing may reflect that. But there are some macro statistics, like Redbook, for instance, Dom, that are showing the consumers in pretty good shape. And certainly, if you listen to the commentary from, the only retail stock that I own is On Holdings. A couple of weeks ago, they gave commentary that said, all systems go. They are just firing on all cylinders. And so I'm not surprised to also see some other retailers like American Eagle are saying the same thing. Is this a rising tide that lifts all boats? I'm not sure, but it probably lifts a lot of boats. Bottom line, I think the consumer's in better shape than it's being given credit for.
Stephanie, a lot of commentary has been about the specialty retailers maybe doing a little bit of outperformance based upon just what their target demographics are, their customers are. You own Dick's, you own Target as well. What exactly is going to be the differentiator for you this season with regard to how you would want to stay in a stock versus say maybe this season wasn't what we thought it was going to be?
So I've been adding to Dick's. It's a fairly new position for me. I added recently to Starbucks. It's a fairly new position for me. Target I've been trimming. I needed the cash to buy these others, and I think it's the opportunity cost. And I think Target is a problem child, and it's going to take a while to figure out, but it's too cheap for me to sell out completely. Now, when you look at the names today, they're very company specific. I mean, American Eagle got the product story right. Then they got the comps accelerating, and they also have very strong management as well, and then margins, and then the guide, right? So that stock is up. It's a very high beta name. It's not that expensive, though, at 18 times for the growth that you're getting. Kohl's was the problem child for 5 years, and now they have new management, and they, too, are getting their act together. The strategy is working. I would not be chasing Kohl's here. Up 70%, 71% for the year. It's not expensive, but I think that's space. I think department stores are not the winners. I think we have the haves and the have-nots, the Costco's, Walmarts, and Amazons. Maybe someday Target. I'm not even going to count that in right now, but those are the haves. Everybody else, it's going to be very company specific. On Dick's, I love this management team, and their core business is doing phenomenal. Their same-store sales last week came in at 5.7% versus 6.4% a year ago. They're comping the comp. I mean, they're doing amazing. They have the products. People are going to the stores. They have the traffic and the transactions. The one problem is Foot Locker. That is going to be a turnaround part of the story, and that's what I like, because I don't want everything to be working perfectly. I want to have some turn and see some operating leverage.
Joe, can we talk thematically quickly about some of the holdings that you have that are tilted towards the off-price side of things? I mean, you do own Burlington, Ross Stores, TJX, amongst others. What do you think?
So the names that are not working, first of all, Burlington, they're blaming warm weather for traffic declining, but yet to your point, TJX and Ross Stores is working well. Williams-Sonoma not working well. Garmin not working well. Costco not working well. Walmart, another new all-time high today. The name that I would really watch is Ulta. They're going to report Thursday after the bell, and this is with a forward-looking PE at 21. For Jimmy, it's reasonably valued. It's attractive from a valuation standpoint, but the growth is also there. They have limited online promotions, and I'll say this about the younger generation. They are doing two things. They might be doing more, but two things that I know of related to the market that our generation didn't do. They invest early, and they spend way more on beauty than we did at their age. Ulta has taken advantage of that. They have a college tour where they're going out and visiting campuses and engaging that younger generation, and that really is their evolving client base.
I can't even believe how much my 8-year-old daughter spends on
skincare, fragrance,
beauty products.
Just you wait.
It's just I can't.
It's crazy.
I can't even fathom just what it's going to be like when the teenage years come around. All right, coming up next on the show, we're tracking the trades here. Stephanie Link is ready to tell you about her newest buy. Stick around for that name. Halftime is back after this.
Nancy Sagalos with your CNBC News update. Hamas says it handed over the body of one of the last 2 deceased hostages in the Gaza Strip. It came as Israel said it would reopen the Rafah border crossing between Gaza and Egypt within days, but only in one direction. Israel says people can leave Gaza but won't be able to come back in until all hostages have been returned. Ukraine's foreign minister says U.S. Special Envoy Steve Witkoff told the Ukrainian delegation that peace talks with Russian President Vladimir Putin yesterday had a positive outcome. He also said Ukrainian officials were invited to the U.S. in the near future to continue negotiations. Meanwhile, the Kremlin says Russia is ready to meet U.S. negotiators as many times as it takes to reach a deal. And Mexican President Claudia Sheinbaum says she will attend Friday's World Cup draw at the Kennedy Center in Washington, D.C. It will mark her first face-to-face meeting with President Trump. Canadian Prime Minister Mark Carney will also be there. The 2026 tournament will be held in the U.S., Mexico, and Canada. Dom, back to you.
All right, Mackenzie, thank you very much for the news update there. Now to one more committee move here. Stephanie, you've got a new buy, and this one is in oil and gas.
Yeah, up until I bought SLB, I didn't own any names. I'm not a huge fan of the energy sector, but I do like SLB a lot. The valuation is very compelling at 13.8 times earnings. You get a 3% yield. The stock's still down 3% on the year, but they're the #1 oil field services company in the world, and they're going to benefit from their customer spending. And the capex for their top 10 customers is going to be $208 billion this year. That is a nice tailwind for them. And in addition, they are the technology leader in the space. They've seen margin expansion as a result, very strong retention with their customers, and they've just done a deal that is going to be very synergistic, accretive to earnings as well as to revenue. So it's kind of a special situation, but I kind of like getting these #1 players in any given industry on sale, and I think that's what I'm doing.
And you know who I'm going to go to next for this, right? The person who talks a lot of oil and gas for us here. Bryn, how do you react? Do you like the SLB buy for Stephanie? And where else do you think money can be put to work in oil and gas?
I love it. So I'm glad to have Stephanie in the space. It's hard space. A lot of people want to rent the space, not to own it. I do think if we can get oil to stabilize, I think a lot of the E&P players are cheap. But once again, we need oil to stabilize, let's say in the 60s, so we can get some more production. And so I think it's a good area to dollar cost average. We own Viper Energy, Energy Transfer, so the pipelines, the mineral rights that have a dividend yield, a really high distribution yield. So that's the majority of the way I've been playing it.
All right, Jim, what do you think?
Well, I've been bullish on the energy sector of the stock market for quite some time, and I've done that in the face of crude oil, which is down, I'm looking right now, 16% year to date. Why has energy given a positive response even though below the market? The reason is because of natural gas. Natural gas 2 years ago was below $2. Now it's at $5. We got a cold winter. We've got demand across the world for liquefied natural gas coming out of the United States, and it just shows that why I like to be in a major diversified company like ExxonMobil that does more than just crude oil production, does natural gas, does refining. Joe, you've talked a lot about the refiners recently. Chemicals, transportation, distribution. Energy is a good place to be right now.
All right, there's the energy trade for you, everybody. Coming up on the show, we're going to debate our top calls of the day, plus why Uber shares are getting a boost today. Halftime is back after this. welcome back to the halftime report. As you just saw there, the Dow's at session highs right now. Let's get to some stocks on the move. Uber is rolling out robo-taxi service in Dallas as part of its latest expansion. Joe and Stephanie both own it. So maybe, Stephanie, we'll start with you first on this.
Yeah, I mean, this is great news. I've been kind of perplexed as to how this stock has traded. They, after earnings, which they beat on earnings, on revenues, on bookings grew 25%. Trips grew double digits. Usage grew 17%. All of this was good, and the stock is down 8% from its highs. So I think it's just biding time. I think the fundamentals are very strong. I'm a big believer. So I like this for the long term, and I think the news today is obviously very positive.
Joe, what do you think?
10 cities autonomous by the end of 2026. They already are in Austin and Atlanta. I think this is obviously, as Steph has said, it's good news. I think also technically you have to like that the stock went down and it challenged the $80 level. That was a key swing area for this stock. It was resistance earlier in the year. 81.51 was the low on November 21st. It held there. It's back to 91. The stock seems to be trading between 80 and 100. I think 101.99 is the high. Ultimately, I think it breaks out above there. This is a company that has grown into its valuation and it's maturing. And this is the way these types trade. They don't take the elevator up. They go up the stairs once they mature.
But still, it's 17 times forward estimates for decent growth.
Yeah.
Absolutely.
All right, so let's go to another sector that has gotten a lot of headlines as of late, and that's healthcare. After being an underperformer for such a long time, it's now really turned the tables. It's been a momentum machine so far. One of the names up there is Vertex Pharmaceutical, which is being upgraded to overweight today. The target price is being upped to $516 a share from $438 at Morgan Stanley. You can kind of see there. Jim Lebenthal, Vertex is a name that you own.
I very strongly believe in it. I agree with the upgrade. When we talk about Vertex, most often what we talk about is the cystic fibrosis franchise, which is their bread and butter. And then on top of that, the new pain medication, Journavax, that they just got approved about a year ago. What we don't talk about is what's to come next. And as my analyst, Ralph Coutant, who covers this often says, Vertex has a huge number of shots on goal. The next one to come is the kidney franchise that is up and coming. They're building it right now. There should be some good data coming out in 2026. That's what the Morgan Stanley analyst is pointing to, and it just points out that there are multiple shots on goal for this company.
All right, and Stephanie, I'm going to go to you with this last one here. GE Vernova is being reiterated as an overweight/buy rating at JP Morgan. You own it. What do you think?
Yeah, I mean, I own this. I own Quanta Services. I own Rockwell, Eaton. Electrification. It's a decade-long theme. This company, though, has margin upside and free cash flow upside that I think is underappreciated. So, yeah, I would use the 8% pullback from the highs to be adding to it.
All right. Coming up next on the show here, Mike Santoli is going to join us with his midday word. Keep it right here. We're back after this. Dow's up 370 points, session highs right now. We are back on the halftime report, and it's that time of the day. Senior markets commentator Mike Santoli with the midday word. We've been building up some momentum throughout the course of the last couple of hours.
Yes, definitely firming up below the surface. And I think what's interesting is the very cyclical character of what the leadership is today. So you get a weak jobs number to start the day. You know, ISM services not particularly great, and yet the market is really locked into this idea that growth is kind of troughing and we're going to reaccelerate. You look at transports. One thing I've been focused on is the consumer lenders, Capital One, Synchrony Financial, card issuers making new highs. They're not cooperating with this idea that you have this constrained consumer. Whether the market's right about this or not, that's kind of the way money is migrating at the moment. Then I think it's just kind of the seasonal upside drift that we get here. You might end up with a 15 handle on the VIX today or tomorrow if this continues because you're kind of bleeding volatility out of it. I do wonder, though, if we'll really get kind of released to the upside before the Fed. It feels like you're going to be capped in there by some of the big catalysts.
So how much of this is, you know, we've made it a cliche in the past, is good news, is bad news, is good news, is bad news, good news?
It's really interesting because I don't know if bad news is explicitly good news because the market hasn't really embraced when bond yields have gone down on a day-to-day basis. In other words, it's not really looking for that because we're already expecting the cut in December. I think it's much more about everyone's year-ahead outlook incorporates some kind of tailwinds kicking in, the tax benefits, and for now, looking at those groups that have not really participated as much, something like a transports, that maybe you can just make a bet on.
All right, and those seasonal trends do tend to help maybe a little bit as well there. All right, Mike Santoli, thank you very much. We'll see you later on this afternoon. Coming up next on the show, the committee's top picks for 2026. What's on their value shopping list? Halftime is back after this. All right, welcome back. Let's get the committee's top picks, their holiday shopping list for the year 2026. We asked each member to give us one stock they own that's underperforming the broader market, but that they think is due for a bounce. Bryn, we're going to start with you.
Apollo. I think Apollo could easily trade up to 160 just on technicals alone. I think for 2026, we've got positive macro background with GDP, having tailwinds from the fiscal stimulus as well as data center growth. They have fee-related earnings that are supposed to grow at 20%. And with their insurance annuity business, Athene, they have a long duration capital base. And so I just think there's been an overreaction because of the private credit concerns. And so I think stock could easily trade once again 160 next year.
All right, on the holiday list, Apollo. Jim, what do you think?
Lockheed Martin. It has been an annus horribilis for Lockheed Martin. That is Latin for a horrible year. It started actually a year ago when Elon Musk punked the F-35 in a tweet. Stock started going down then. Then they had a huge first quarter charge for a classified program. They lost the F-47 to Boeing. But in the meantime, the F-35 is the best airplane in the air right now. Other countries want it. Our armed forces want it. The missiles are a hot seller. I hate to say that, but it is, and it's trading at a very forgiving valuation right now.
All right, Stephanie, what do you think?
Starbucks, the stock is down 6% year to date, and they have a great management team. New CEO, Brian Niccol. The turnaround is happening faster than expected, and I think 2026 they will make progress throughout the year. They had the first positive comp in 2 years last quarter, and what they're doing to the stores is working. They're getting people in again, and they're spending. So I like that story.
All right, what's your value pick?
Cadence Design Systems underperformed the S&P 500, but yet outperforming its industry peers. That is telling you something about a company that designs software for chips in an environment where robust chip spending will continue.
All right, the holiday shopping list. Thank you very much to all of our committee members for those. Stay with us because final trades are coming right up right after this break. All right, it's that time of the day. We're back with final trades. Bryn Talkington, to you first.
Yeah, the iShares Ethereum Trust, it's 33% off its high that it reached this summer. Buy low, sell high.
All right, what do we think there, Jim?
Citigroup, it's had one heck of a year, and yet it's still the cheapest of its big bank brethren.
All right, Stephanie.
Bank of America, the net interest income is poised to go higher given the steep yield curve, strong capital markets, and cost cutting, better profitability ahead.
And Joe.
So Jimmy talked about natural gas before. EQT is a great trade, and I can't wait for Scott to get back into town. I'm going to have an answer for him where we go. Looks like we're breaking out higher.
All right, 2 money center banks as part of that discussion. Thank you guys very much for having me here today. Good luck to everybody here. That does it for us on the halftime. The exchange with Kelly Evans starts right now.
Thank you very much, Dom. So what matters more to the markets? I think we're finding out today, whether it's AI or lower rates or maybe a little bit of both. Welcome to the exchange. I'm Kelly Evans, and stocks are mostly higher right now. The Dow is still up 0.75%, so it's actually leading the way today as the Nasdaq has been under pressure following these Microsoft headlines. Now, the company this hour is pushing back on the report that they're lowering their sales quotas for AI products. We'll get into it, some nuance here. By the way, Microsoft shares off the lows, down 1.4%. Here we go as well, a big miss on the jobs front with the private sector shedding, the most since March of 2023. ADP tells us this morning, most of these cuts also coming from small businesses. Probabilities for a rate cut, flip side of this coin, right now they're at 85%, so pretty much a slam dunk guarantee. This also has the 10-year falling below 4.1% today. Keep an eye on what's been going on, meantime, in the metal complex. Some are calling it a bit of a supply squeeze, but typically it's a good sign when copper's breaking out, which is up 3% today to right around all-time highs. In fact, same for silver as well, for what it's worth. Let's begin with the markets, though, in this story about tech lagging as Microsoft is pushing back on a report from the information that they're lowering sales quotas for their AI products. That headline around 9 a.m. this morning sent the stock lower, took the whole NASDAQ down. And it's still feeding into some lingering concerns around the AI build-out and demand and the Mag 7's outsized impact on this market, while the weak jobs data is adding expectations for a rate cut next week. So which one dominates the investment landscape right now, AI or lower rates? Joining us to discuss is Andres Garcia Amaya. He's the CEO at Zoe Financial, and Michael Sansotera is the CIO at Sylvan Capital Management. Welcome to you both. Andres, take it away. I mean, does the price action... It's not so much about the nuance of the Microsoft stories. No, we've lowered our growth target, not our sales quotas. Nevertheless, the markets obviously remains highly concerned about the AI demand narrative.
Between those two, I think the AI story is more important because it's tied to earnings, especially for some of these large technology companies. Let's put it this way. If the Fed lowers 25 basis points and stops, but the top 7 technology companies continue to blow out earnings, I think the rally continues.
Yeah.
It wouldn't work the other way. If earnings stop working and the Fed were to, cut 50 basis points, I don't think that would be enough to continue the rally.
Well, probably because it would just tell people this is a literal slowdown, right?
That's
You don't want that. You want the kind of COVID unwind. Do you think that's what's going on with the labor market, Michael? Is that we're still unwinding some of the COVID excess hiring and there's other things?
I think the labor market is struggling to differentiate between maybe some tail end of COVID, but probably more short term has been the change in immigration policy. So I think as you see immigration policy solidify a little bit, and we get a better arms around exactly who we are and aren't letting into the country, you might see a little more clarity there. But again, the ADP data is kind of notoriously not quite right.
Absolutely.
So it's a little bit. I'm not particularly worried about it at this stage.
No, fair enough, but I think you're right. There's been questions about out-migration. You could throw tariffs into the mix. We've had the government job cuts and the shutdown that was then kind of weighing on things. Some argue AI itself, is what's going on here. So do you sense, I know a lot of your investments are these big tech players.
Right.
Do you have any concern about holding on to the Microsofts and the mega caps here?
No, I think you're going to have these windows where there's fear. Fear in the market's actually healthy. It keeps the valuations from going crazy. Right now, the strength of the capex in these players, the strength of the demand for chipsets is off the charts. And what we've seen is the commitment from the hyperscalers in particular. We saw this commitment before when they were building cloud computing in 2006. We saw it in the internet in the 90s. They're not going to stop spending. The return on invested capital is coming. If it takes years, it takes years, and it typically does to really get profitable. They're fine with it. So this is a longer-term trend. You're going to have little moments where the stocks get frightening and people get scared.
Yeah.
But no ultimate change to where they sit.
But Andres, it sounds like you have a little bit more concern about maybe that. Do you about valuations with some of these major platforms, or no? About the AI story, is that one that helps you sleep at night, or no?
I think the higher valuation just creates less room for error. I do believe that if earnings continue to deliver, there's not as much of a concern there. The bigger concern is if they stop performing from an earnings perspective. Having said all that, I wouldn't look at next year and say, well, in that case, should we see 4% returns? The reality of it is, when you look at history, the last two times we had kind of a revolutionary technology, personal computers in the early 80s and then the late 90s, the party was 5 years long, and it was not 1 year up to, and then it was all of those years were up more than 10%.
Crazy.
So next year would be the fourth year of this. So we're more like in the middle innings of this, if it is.
And this to you is the bull market that started, 2022 after that reset, and as ChatGPT came on the scene.
Yeah, I think the ChatGPT changed the whole game because all of a sudden there's now a demand for this new thing. And all of these companies are actually they're not demand constrained, they're supply constrained, which tells you it could go on for longer.
Yeah, and you also think, there's a little bit of this year 4 of the bull market thing in general, where it's usually not a time to bet against it.
Right. If anything, these cycles end in a melt up, right? Everyone talks about the markets are driven by either fear or greed. But there's a missing component, which is envy. And at the end of these rallies, you get people that have been sitting on the sidelines and saying, okay, now I can't miss it. So there could still be that part of the cycle.
What would you add, Michael?
Yeah, I would say that's spot on. The longer it goes, the harder it is to ignore. And there's still lots of investors ignoring it. Retail's been excited, and that's been clear. But there's lots of institutional investors that are still not sure, not certain, and they're woefully behind their indexes, right? That you can see 1,000, 2,000 basis points underperformance of some fantastic money managers that are just decidedly out of favor with the way the market's behaving. And if that continues another year after, you do ultimately get capitulation, and that melt up that he's talking about, that happens at the institutional level, and that's usually the bell ring.
Right, and we're not there yet. And I think there's a couple of things to unpack here. One is the psychology of it. Another is kind of the trend following nature of it. And then the third and the most important one, as Andres mentioned, is the actual earnings underpinning all of this. And so to you, and I know you follow these, especially the big tech companies closely, you think that's solid, that all the investment now, there's going to be enough future revenue to generate enough solid earnings to justify, again, multiples that are not crazy, but valuations and sizes for these companies are already large.
Sure. 2026 is largely understood, I think, from an earnings perspective by the largest mega cap hyperscalers. The growth rate will probably be still in that 15-16% range.
Wow.
It's decelerated a little bit from 2 years ago, 3 years ago, but it'll be sequentially relatively flat. And in fact, actually could increase as some ROI begins to show up at those companies specifically. So as long as that continues, and that's what we've seen for the last few years, which has been frustrating for so many investors, is that mega cap are carrying the market, and everyone wants that to end desperately, except for us. So your goal is to understand that if that continues mathematically, the earnings keep coming, they will continue to garner revenue, earnings, free cash flow, and therefore price appreciation.
Quick final thought from you both. Michael, to you first. On any Microsoft-specific concerns, do you share? Look, everyone knows that Copilot is not ChatGPT, right? Does it matter, especially if all their money, as Steve Kovac has been talking about for a long time, their money is coming from kind of the back end of this more so than the consumer product?
Right. Yeah, I'm not worried about any sort of short-term news blip about what salespeople are doing. Microsoft's a company that's had a pretty focused sales force on the whole AI movement, and you're going to see tweaks in between, any particular product, any particular pricing at any time, and that's no reason to get nervous or even off the train.
Finally, then, Andres, just to broaden it out, if we can feel kind of comfortable about where earnings growth is coming in for the big cap tech players, what about the rest of the market? Should we also expect this broadening as we get lower rates? And we'll talk about this more next week, but even some signs that we could get some consumer help early next year.
Yeah, I think the sleeper here is international stocks. If you want to remain risk on with equity, IFA is up more than 30% this year. Emerging markets up more than 30% this year. And that cycle is just beginning of emerging markets and internationally outperforming the U.S.
It's not just a one-year quirk.
Well, usually these things go in cycles, right? And the dollar's weakening, which helps those stocks. And we don't know when the party will end, but if it does end, those markets tend to outperform the U.S. So
Even when it does end.
Yes.
Yeah.
So it's a good way to diversify. If you're already, super long NVIDIA, as pretty much anyone who owns the market does, there could be some diversification while still owning equities.
Fair enough. We're going to talk more about this next time. Gentlemen, for now, thanks. Appreciate it. Andres Garcia Amaya and Michael Sanzatera. Elsewhere, in the crypto world, I should say, Bitcoin is holding on to its gains today. Still right around the 92,000 level as it touched about 85 last week. It's at 93 and change now. And our next guest says the move could still be to the downside, but if it does, it'll be a great buying opportunity. Let's bring in Jeff Kilberg. He's KKM Financial's founder and CEO and a CNBC contributor. Jeff, it's great to see you again. Welcome.
Kelly, on behalf of the middle of the country, it's great to see you back. Welcome back.
Thank you. Do you want to pick up on anything you just heard before we dive into the Bitcoin layer here?
Well, I think it's interesting talking more about international, but I think international has played a part in a portfolio, but I really see the broadening of the S&P 500 equity market outside of the Mag 7, the rotation inside the Mag 7. I think that's going to be the more of the major theme going forward as we see interest rates move down. So I'm optimistic on equities. I think we see the Santa Claus rally here in the month of December. So I am optimistic, but I think there's going to be more broadening. It's not going to be the usual suspects per usual.
Okay, so is that why you're worried about Bitcoin possibly taking another leg lower here? And again, you're someone who owns it and I think is long-term bullish. Correct me if I'm wrong.
Correct.
Describe what you think is going on here.
I think saying equities and crypto in the same sentence is not 2025, nor it's going to be 2026. We saw decoupling. That lack of correlation happened back in April when we saw the NASDAQ 100 and crypto, specifically Bitcoin, really decouple from each other. So I am cautiously optimistic, but I didn't like the fact that we didn't see this pullback, which is completely healthy. Let's remember, Kelly, I go back to 2017. That's when the CME Group started trading Bitcoin futures. So if you look from 2017 until now, there's been about 20 different pullbacks of 25% or more. We just endured a 30% pullback. We've actually seen 3 pullbacks of 50% or more since the future started trading. So I don't think this is unusual. The acute volatility is sensational, but I think the fact that we didn't go back and fill down to that April low of 76,000, that's where I think the market wants to go. But at the end of the day, Kelly, there's so many new organic buyers. Look what Vanguard just did. They opened up the faucet to many more buyers. JP Morgan, there's a lot of new players and products in the accessibility. Look at IBIT. IBIT has had $32 billion of inflows just in this year. So these new buyers, it's very different than the stock market. If you think about it, Kelly, on a stock, there's a sell analyst, there's a buyer analyst, there's always different ratings. Not really in crypto. If you don't like crypto, you just don't participate. So it's a kind of a different animal.
Yeah, I saw Larry Fink saying today that, the more he traveled the country and talked to people, the more he saw the use case for crypto. I would say I understand the use case outside of the U.S., but I almost feel like the more that I talk to people, the less convicted I am that Bitcoin should have any fundamental price value. It's kind of just a community thing, you described.
And that's the head scratcher. So when you saw it up at 125,000, you were getting in Uber rides and you were talking about buying crypto. So that is that kind of moment in time. And now the people who just bought there and seen a 30% drawdown, are they going to take that tax loss harvest before the end of the year? Are they going to have the appetite moving forward? But I do know a lot of the advisors I support, they're trying to really understand what is that crypto exposure, not just necessarily Bitcoin, but what is that crypto exposure moving forward? Is it 1%, 2%? It's kind of like when people are dipping their toes into commodities. Look at gold and silver. Obviously, a completely different
I was just going to ask you. Just going to ask.
That's the more tangible component, and that's where we talk to a lot of our folks. We've owned gold, we've owned silver. It's been very tactical, but this is a conversation which is very different than Bitcoin, which I know is the new modern-day version of gold.
Well, to those who like it, I guess.
To some.
The final then, for 2026, it sounds like you're saying, Santa Claus rally, market broadening, doesn't necessarily mean crypto participates. What's the rest of the narrative for you, the sort of the 30,000-foot story?
I think the 30,000-foot story is that interest rates are coming down. Immaterial, yes. I'm actually going to be out visiting with you on set next week for Fed Day. So, yes, we are anticipating the Fed to have 25 bips. But moving forward, rates are coming down. If you look at the 2-year note, that's kind of the precursor, the predicting component of where the Feds should be. And I think the overarching theme of interest rates coming down, that's going to be supportive of equities. We haven't seen the 10-year really spend much time under 4%. So if we get down to 3.5%, Kelly, that's going to incentivize, it's going to help home buyers. I think it helps a lot of the laggards in the market. I think it helps the financial. I think it helps all the sectors that we've been talking about that have been dispersed from obviously technology and utilities. That's where we see it. But it's interest rates, interest rates, interest rates.
3.5% would be amazing. I think you're exactly right to pound the table about that. And we'll see you next week.
All right, Kelly, thank you.
Thank you, Jeff. Jeff Kilberg, KKM. Still to come, Wall Street is preparing for a record-setting surge of corporate bond sales next year, and it's already been a busy December. And the reason is because all roads, of course, lead back to AI. We've got the details and what it means for the fixed income market next. Plus, Box CEO Aaron Levy will join us on the heels of their third quarter results with some strong guidance, pushing shares back into positive territory for the year. Box is at 5% today. We're also going to ask him about this Microsoft story and demand for AI. The Exchange is back after this.
This is The Exchange on CNBC.
Welcome back to The Exchange. Wells Fargo is initiating coverage of Oracle at an overweight. With everything going on right now, they do warn of the risks, including their significant debt load. And they say Oracle will need to issue new debt for its build-out and could double to $180 billion by fiscal 2029. That's what my next guest is worried about. He says the massive capex required for big tech to grow their AI capabilities has completely upended their financing strategies. Let's bring in Guy Labat. He's the chief fixed income strategist at Janney Montgomery Scott. Guy, it's great to see you.
Hi, Kelly. How are you?
Good. So start me off here. When you see headlines, the talk about the need for raising more debt or the high debt load some of these companies already have, what does it make you think?
Yeah, so there's been this tremendous story arc that really dates back a couple of years. A lot of what the so-called hyperscalers have relied more heavily, not where they used to get their money, which was essentially their own balance sheet and cash flow, but in borrowing. And a lot of that was opaque and a little bit behind the scenes in the private credit and bank lending markets. But really in the last 6 weeks or so, it's gotten a jump forward into the public debt markets, where we had a series of large bond issuances that were used to fund these giant data center expansions. I know we like to talk about AI here as sort of like a little chatbot or a productivity tool, but the reality is the physical infrastructure which goes into creating this stuff is utterly massive, almost
Yeah.
on a scale we haven't seen.
Right. And so is that you're the fixed income guy? Would you run away from all this debt and keep it, at arm's length? Or is this how significant is it? How significantly is it going to change fixed income market?
So our best guess is that over the course of the next couple of years or so, round numbers, the growth of the investment grade corporate bond markets is going to accelerate by about 15 to 20%. That doesn't mean the markets are going to get that large. That means the pace at which they grow is going to get that large. And what that means also is that it's going to be a little bit challenging to finance all this new issuance. And on the margin, it's going to crowd out or cause other sources of financing to become a little bit more expensive. Now, I wouldn't run away from it outright, but I think, at least for our clients here at Janney, there's probably better ways to get exposure to the AI theme and the data center and the tech theme. The investment grade corporate bond markets are probably not the ideal place for it.
That said, I mean, who wouldn't feel comfortable lending to? I don't know what the terms are for Microsoft. I mean, maybe you think twice about Oracle. I don't know. But do you really think any of these companies aren't going to be able to meet their obligations? I mean, really? When's the last time we had a high-profile, bond default by a company of this market cap or of this size? It's probably been 20 years or some idiosyncratic situation.
Absolutely. And I'm not here to suggest that the highly rated names among these companies are going to walk away 5 years from now not being able to pay their debt loads. It's far from that. Really, the effects are a little bit more marginal, right? And so what I'm arguing is that with an extra 100 or 150 or $200 billion of net debt issuance, essentially the supply and demand dynamics of the investment grade corporate market get much more heavily skewed in terms of supply. And that causes funding costs across all issuers to get a little bit more expensive.
Yeah.
How much are we talking about here? 15 to 20 basis points. It's not massive, but it's enough for the investment grade corporate bond markets to perform significantly less well in the new year than they have in this past one.
And that'll be a curious one to watch. Again, they're kind of helped out by the fact that now maybe we have Treasury rates coming down a little bit, giving people some breathing room. You say, look, if you want exposure to AI, you go with equities. Even go with private credit, which I thought was interesting because I'm not sure how I maybe feel about some of the underwriting standards there, as opposed to these IG bonds. But maybe for a different kind of investor, they'd feel a little bit more comfortable going that route.
Yeah, and absolutely. And I mean this from a portfolio construction standpoint, not an absolute you must own this or you shouldn't own that standpoint. But if you sort of look at the long run opportunities within the AI expansion, really those opportunities are what we describe as right tail, right? They're that growth grows faster, and you're able to achieve some of that in an investment portfolio by investing in the cash flows and the equities. Whereas in the investment grade bond market, we're kind of worried about those left tail risks, and that's just not the right place to be able to participate in the AI revolution.
Before you go, Guy, I should say, and well, obviously this all will become much more of a talking point next year, but we just had Jeff Kilburg on who said, when I asked him about why he's so bullish for next year, he said it's rates, and rates. That lower interest rates are just such an important theme right now. And he said, imagine if the 10-year goes to 3.5%. And I was wondering how likely you think it is that we could see a development like that, where we're excited enough for it to go below 4%. But could 3.5% become a realistic part of the conversation in the near term?
Yeah, absolutely. My team and I were actually just finished putting the final touches, crossing the T's, dotting the I's on our 2026 outlook just before I joined you this afternoon. And that's the lower end of our expected trading range in the 10-year. I don't think we end the year there, but it might get pretty close.
Wow. I'll leave it on that note. Guy, thanks so much. Appreciate having you today.
Thank you,
Guy Labas with Janney Montgomery Scott. Coming up, one tech company that's satisfying its debt obligations, that's Box. We'll talk to CEO Aaron Levy about everything going on in the tech world right now about that. Stock's up 5% today. Plus, American Eagle up 15% after beating on earnings and raising guidance. And we'll look at how that Sydney Sweeney campaign drove sales and what it says about the rest of the retail landscape. We're back with more after this. Welcome back. With stocks holding on to a rally, especially in the Dow, which is up 358 points. NASDAQ hanging on to a gain despite those Microsoft headwinds we were discussing, and the 10-year 406. Here are some of the other movers. We have Apple at an all-time high, and that, of course, would help the NASDAQ as well. It turned lower, but this is, by the way, if we manage to end the day in the green, the first 8-day rally Apple might see since early May, and it's up 7% in this past week or so period of time. As for some of the other names hitting all-time highs, we've got Fox, General Motors, Marriott, and Walmart. And on the other hand, Alexandria Real Estate Equity, she said, the worst name in the S&P today. It's down 8%, and you probably saw this news earlier. They slashed the dividend by nearly half. They're going to pay 72 cents a share every quarter versus $1.32, and the stock has now lost half of its value since January at a time when interest rates have been falling, not rising. This is definitely one that's going to be painful for investors. Let's get to Mackenzie Sigalos now for the CNBC News Update. Hi, Mackenzie.
Hey, Kelly. The House Oversight Committee says that it's received new materials from major financial institutions as part of its probe into Jeffrey Epstein. That's according to Politico. Democrats on the committee say the material from J.P. Morgan Chase and Deutsche Bank will be released to the public in the days ahead after review. Meanwhile, Epstein's longtime accomplice, Ghislaine Maxwell, plans to file a petition to be released from prison. That's according to a filing in Manhattan federal court, first reported by the New York Times. Now, according to the Times, the letter doesn't offer details about the grounds she cites for release. Maxwell is currently serving a 20-year sentence for sex trafficking. House Judiciary Chairman Jim Jordan subpoenaed former special counsel Jack Smith today, requiring him to appear for a deposition on December 17th over his investigation into President Trump. Jordan also included a demand for all documents and communications from Smith's time on the job. No comment from Smith yet, but he has already offered to publicly testify before the House and Senate. Back to you, Kelly.
All right, Mackenzie, thank you so much. Coming up, Bach shares are higher after a revenue beat and strong guidance, with management saying customers' AI adoption has surpassed expectations. CEO Aaron Levy joins us to discuss next. Welcome back to the exchange. Shares of Box are jumping nearly 6% today after their Q3 results. Revenue was up 9% year on year. Billings growth up 12%. Here to discuss is Box CEO Aaron Levie. Aaron, a pleasure to have you, especially with all the news flow today. Welcome.
Yeah, thanks for having me on.
I know you want to talk about the company specifically. I know you guys have seen a lot of AI adoption. I don't know if you'd want to speak to your reaction to this Microsoft story about whether or not there's been slower take-up perhaps of its AI products with consumers.
Well, I think what we're seeing generally across the industry is pretty widespread AI adoption. If you look at the growth of things like OpenAI, Claude, Gemini certainly most recently has had a breakthrough, Grok through the X platform. And so I think there's pretty widespread AI adoption. And certainly what we've seen within our own context and within our customer base is increasing AI adoption really for applied use cases. And so I think what really matters is, do you have use cases where AI can help transform workflows or augment how people work in a way that drives increased productivity, efficiency, or even revenue gains? And that's what our platform has been delivering. So no comment specifically on what Microsoft is seeing, but they've been a great partner, and we continue to work with them and many of the other players out there.
But in other words, you know, this isn't a passing fad. You think like this is fundamentally changing workflow. I mean, I agree with you. I'm just trying to play devil's advocate here. I use it obsessively, but I'd love to hear more about on the corporate piece of this too, what the demand is like, and if you think it's going to be true for years to come that we remain in a supply constrained environment for this technology.
Yeah, this is a tectonic shift in how we are going to work in the future, because effectively what you have is near unlimited intelligence at your disposal for any task that you want inside an organization. Now, there's a big caveat, which is that intelligence really has to be applied in a particular area or task. It can't be a sort of widespread intelligence, maybe in the way that the sci-fi people would have predicted 5 or 10 years ago. It's really about task-specific automation. So in our organization, you know, when we work with customers, we have 120,000 customers, and what they do is they store their most important data in the Box platform. That data might be contracts or invoices or research documents or FDA drug trial and clinical trial information. And inside of all of that information are critical insights. And so what companies want to be able to do is have AI agents answer questions about that data, extract intelligence from those documents so they can automate workflows or get analytics on them, and then ultimately be able to augment their own productivity. So that's driving sort of unquestionable results for customers that have implemented the technology and the solution. We are still very early, but this is a shift that is effectively unstoppable simply because of the productivity gains that customers get when they deploy AI at scale.
Yeah, so I appreciate that. And for those, I mean, I guess we then just ask questions. Where's the price points? You know, what does the competition look like? Does it matter if this is all being powered by TPUs or GPUs or what have you? You know, what do you think?
Well, I think there's a lot in there to unpack. I think, you know, certainly from a, you know, maybe a stock investing standpoint, you have to care about a lot of those elements. I think when you're building on the technology, what you see in the inside of, you know, being right in the center of Silicon Valley is we have this incredible moment where you have, you know, between 5 or 10 major platforms and players, between the hyperscalers, the models, and a few other players that are effectively racing to be able to provide more and more capabilities around superintelligence. And all of that leads to more capability in the AI models, which means there's more innovation that you can drive on top of those AI models. So whether it's TPUs or NVIDIA chips or, you know, a different architecture, I think it's great to have more competition in this space. But if you zoom out and you look over the next 5 or 10 years, we're still in the earliest phases of this wide-scale change. And so that's why I'm generally bullish on, you know, most of the layers of the infrastructure, including NVIDIA, including Google's approach. I think if you were to go back 15 years ago and you looked at the cloud wars that we saw between AWS and maybe the early stages of Google Cloud and Azure, you might sort of say, well, okay, you know, how is this $30 billion industry or whatever it was going to, you know, carve out between these 3 or 4 players? And then you zoom out today and 15 years later, and this is a multi-$100 billion market in terms of annual revenue. And it turned out that actually all of the players ended up doing very well. So I think if you look at AI through that type of lens, I think we're still in the very early phases of what's going to play out from a market share or you know, market composition standpoint.
I appreciate that. I mean, it's exciting. It seems even with your business like it's reinvigorated things, and it's fascinating to watch how the cloud wars kind of now begot the AI evolution and all the rest of it. I suppose the only thing that I wonder too, still is about the software component. You know, when you talk about the way that enterprises are able to use proprietary data and interact with it, do we still have this anxiety that that displaces other services or other workflows, or do you think that that's gone away a little bit?
Well, I think you just sort of nailed it. So if you think about AI models, they're effectively trained on largely public information, or at least information that the labs can purchase and procure, which means that what you're building is this sort of very general superintelligence in the form of an AI model. But that intelligence is only useful within an enterprise if the enterprise can give that model context about its business. And so where is that context? Well, largely it's in your data. And so in the case of Box, we help our customers store their most important unstructured enterprise data, contracts, research data, medical information, financial documents. And so all of that becomes really, really important context for AI agents. But those AI agents might need access to other tools or systems, which again come from the software providers that might already exist, or even new startups.
True.
So I think we're going to live in a world where agents have access to corporate data that you give, that you allow those agents to access, and we're really happy about our position as being one of the leading providers of that kind of platform. And agents will have access to software tools that they leverage, like Salesforce or ServiceNow or Workday. And I think it's the collection of this environment that will make agents effective in the future, which is why
How can it be that everybody wins? Like, it's good for the software players, it's good for you guys, it's good for the chip companies, it's good for big tech, it's good for the consumer. I mean, is it just this easy? It's just good for everybody? I mean, I guess the only downside is potentially these higher power bills.
I think it's okay to have a non-zero sum approach to a technology movement. If you think about, again, 15 years ago, and you were to say, how could everybody in SaaS win? And you looked at Workday, maybe had a few $100 million in revenue, and Salesforce maybe had $1 billion in revenue, and you had ServiceNow with $1 billion in revenue. You say, how is it that all of these players could all grow 10 or 100 times from where they're at today? And it turned out that the world just needed way more software than what it had at the time. And even the most stark examples of sort of a winner-loser market of, like, let's say Oracle versus Salesforce, it turned out even Oracle and SAP and some of the mainstays in software did extremely well during that time period.
Is it true? So I think, and I love that point, and you're absolutely right. But now that they're so big, can it be the case that we still need exponentially, or maybe that's putting it too strongly, but multiple times more software and more of everything than we already have? I mean, these companies, some of them are multi-trillion-dollar companies.
Totally. So, valuation and sort of stock picking aside for 1 second, just think about this for software. When we sell Box to an enterprise, or Salesforce sells us, Salesforce to an enterprise, we are reliant on there being users on the other end of that deal to use all of the tools in our software. And so customers have actually always been constrained by, in many cases, the lack of human resources that are on the other end of that software transaction to make the tool effective. So the reason why you're going to see a lot of market growth because of AI is that now the software will come with the users with it. And so we can deliver useful work on our software along with the licenses for our product. That will actually drive growth, because now you can go after a small or medium-sized business that maybe previously didn't have a person that could go label all of their contracts that came into a document management system. Now the agent can go and do that, which then increases the TAM for being able to be a law firm that now uses AI to be able to help automate their contract workflows. So you're going to see a lot more of this market expansion due to AI agents, even in the SaaS space, as well as many of the new startups that will emerge in the various categories.
See, that's why I like talking to you, because you bring me to exactly the place in which I understand, not quite the 0 to 1 analogy, but you get where I'm going with this. Aaron, thanks very much. Really appreciate it today.
Thank you.
Aaron Levy joining us from Box. Coming up, it looks like Google's gains are to some extent Microsoft's pains right now, because Alphabet shares are up 31% in the past 2 months, but Microsoft's down 7%. Should Sam Altman's Code Red declaration extend beyond ChatGPT to one of its biggest partners? We'll discuss that next. Eat that. Clearing my throat. Welcome back to the exchange. Shares of Microsoft are still lower today, although off the lows. They clarified this earlier report from The Information that said Microsoft lowered their AI sales quotas. The company said that report inaccurately combined the concept of growth and sales quotas. The Information's headline is now updated to say that Microsoft has lowered its software growth targets. Following along, let's do this in today's Tech Check. Deirdre Bosa is here with a look at what this all is really telling us, Dee, about the AI agent landscape.
Yeah, because there was a lot of back and forth. But the big picture here is that enterprise AI spend, it's not lining up with the early narrative. Companies are leaning into model usage, but they're moving slower on agents. And that context matters as we dig into that Microsoft story. Now, they've pushed back on reports that they cut AI quotas, but not necessarily around slower growth expectations around those agent products. Now, Sam Altman, too, in that Code Red memo, told OpenAI's team that resources are going to be shifting away from agents to rebuild the ChatGPT, the model experience. So there's this data from RAMP that we found really interesting. It shows that there is another side to this story, and it runs through Anthropic. The startup just posted a sharp jump in business adoption, according to this data, even as OpenAI, still the largest player, is seeing its gains, its momentum settle. Now, the driver for Anthropic is API demand. I'll explain what that is, but it's not agents. Agents are a top-down strategy sold to executives. API is a bottom-up approach adopted by builders within companies. So for investors, it raises this question, was there too much hype around agents? And the spend that we're actually seeing is flowing into model access, and increasingly, that is Anthropic's Claude. Now, agents may still have their moment, Kelly, but they are turning out to be far more complex to roll out at scale than advertised. And that may be why Microsoft, that remember was pushing agents earliest, they went from the early winner in the AI race since ChatGPT's launch 3 years ago to now being the biggest laggard, even behind Amazon and Apple. Isn't that interesting?
It's extremely. So restate that for me again, Deirdre. What do you think it is that they are kind of missing the boat on here?
So we've been companies, Microsoft especially, have been, and Salesforce as well, have been pushing this agent narrative. The idea that AI is going to be automated to complete tasks on your behalf, and that's what enterprises are interested in. What we're seeing instead is that they still want APIs. That's just building their own products with the underlying model. And that's why you're seeing Anthropic sort of gain the momentum in enterprise, because it's the builders inside of these companies. They don't want agents. They want to be able to use the model to create their own workflows, not sort of these complex models that will do everything for you, because they can't right now.
Did you hear our discussion with Aaron Levy? He was kind of talking a little bit about this, and I like what you're adding, which is a layer of nuance here, that it may be that AI enables companies to kind of do more with than they might have before with software, but you're also saying it's not that to say that the AI is going to do it perfectly for them. Like, there might still be a layer here where you need people or products that are going to be able to be tailored exactly to what it is that you're looking for them to do.
Right. And if that's your expectation, that's not necessarily the reality. I had a long conversation with Aaron about this a few weeks ago at a dinner, and he sort of said, it's not just the year of the agent, it's the decade of the agent. So he says himself that this is going to happen, but may not happen sort of automatically and as quickly as everyone wants to. Yeah. And I think that's what this says as well. It's not that agents aren't going to be a thing. It's just that they're not as useful right now.
Yeah, exactly. It's not there yet.
And the code is. We know that. We know the code is. Yes. But then those gains flow through to a player like Anthropic, which is interesting, by the way, Kelly, because Microsoft put all their eggs initially in the OpenAI basket. And it turns out that Anthropic API's Claude Code is what enterprises really want.
That's fascinating. I love all the different emerging winners here. Deirdre, appreciate it for now. Thanks, Deirdre Bosa. Thanks. Still to come, the retail ETF is up 11% in less than 2 weeks, and Bank of America expects the already strong holiday shopping season to get even better. Oh, thanks to AI. Come on. We'll have the details next. And as we head to break, stocks are at session highs. The Dow's up 429 points. The tone has improved dramatically. We're back after this. Welcome back. Holiday shopping is off to a pretty strong start. Adobe is now reporting that online sales between Thanksgiving and Cyber Monday grew 8% from last. That's a big number, certainly beating expectations. I mean, even with inflation, that's pretty good. It has Bank of America bullish on e-commerce and on two stocks that share one common name, Rufus. Here to discuss is Justin Post. He's internet analyst at BofA. You see what we did there, Justin. I love Rufus. I use him on Amazon all the time. That's where you're going with this, right? Welcome.
Great to be here. You know, we saw a pretty good online shift starting in March and April, and we do think that's somewhat AI related. And then we really think Rufus on Amazon has kicked into gear. We're seeing very good usage data. And I think overall AI shopping is increasing. You're seeing some numbers up 800% year over year. And I think that's driving a kind of an online shift right now. So definitely think offline is kind of mixed, but online's doing quite well this holiday.
There's two areas I've noticed myself using AI to do more e-commerce transactions. It's literally with I'm not saying I use Rufus every single time, but I think I was asking him about whiteboards or something. And again, you're trying to get through the clutter of Amazon's website to just something simple, or to the clutter of the sales function to get to what you want. And I thought it was helpful with that. The other piece is using ChatGPT. So I did like a little small project in the house, and I said, where do I buy a little desk like this or something or other? And of course, it says IKEA, and I would think IKEA, but it tells me exactly which one. And I'm going and I'm completing these transactions, and normally it's something I would just kind of let linger. I'd feel too overwhelmed to finish the project. So it's got to be driving volume. I think if it's working for me, it probably is working for other people as well.
We think it is definitely seeing increases in conversion rates of people who are using AI versus not using AI. I'm sure OpenAI has some pretty interesting data on that hasn't been quite shared yet. But within Amazon, some of the third-party data says that the conversion rates are much higher for people using Rufus. So better shopping experience, and I think that's going to accelerate the shift of purchasing online, and you're seeing the benefit of that in sales the last couple quarters.
Should we get into our whole grocery debate from yesterday about, I think they should just let Whole Foods go on DoorDash? I don't know if you agree.
I think Amazon's got a fleet of their own delivery people they'd probably want to utilize more. But certainly they are trying to expand their grocery offering, both getting Whole Foods to people, but they're even delivering for third-party grocers as well. So they really want to increase their grocery offering, and we think that's one of the bigger growth drivers for retail next year.
And quickly, if people are watching and agreeing with your thesis, what other names should they own here?
We think Chewy could be a beneficiary of the shift online. Certainly getting past maybe some of the extra expenses last year could help with margins, but overall would be a shift to online purchasing, which we think would benefit. We highlighted both Amazon and Chewy had very strong traffic in November.
That's fascinating. That's why we were talking about Rufus. I appreciate it, Justin. Thanks for your time today.
Sure. Good to see you again.
It's good to have you. Justin Post with BofA. Sticking with retail, check out American Eagle shares soaring 14% after better than expected results and raising their full year forecast. And they already had that great quarter last time. The shares are at their highest level in a year and a half now, up 150% from their low about 6 months ago. And this is all thanks to the company's recent marketing campaign with actress Sydney Sweeney. Of course, they're not the only retailer hoping celebrities will drive denim sales either. CNBC.com retail reporter Gabrielle Fonrouge is here with a closer look. Who cares what anyone else is doing? Don't you think they already won? It's game, set, match.
Well, I mean, if you look at my reporting, the people that I'm speaking to are showing that Levi's is actually winning this race. And when you dig a bit deeper into American Eagle's results, the growth there is being driven by Aerie, which has nothing to do with jeans. So the attention on American Eagle overall from the marketing campaigns, is that driving people into Aerie? Perhaps, but what we saw last night, which was really interesting, is that at the namesake banner, American Eagle comps were only up 1%. Analysts were looking for 2.1, while comps at Aerie were 11%. So they're spending all this money on denim. Is it working?
Aerie, if I go back to several years ago, are Aerie stores separate stores from American Eagle, or are they within the American Eagle? Connected. Okay. And apologies to the audience, they sell bralettes. That's my understanding.
Intimates, pajamas, lounge, underwear.
Okay, pajamas and lounge. We're in safer territory here. So you're telling me that American Eagle stock and all of the sales blowout numbers we've been hearing about for the past several months are because of pajamas and not because of Sydney Sweeney's jeans?
Well, look, last quarter, there was a lot of bullishness about the campaign. You know, it was way too early for them to talk about the real sales impact yet because it had occurred, you know, the tail end of the quarter. But what they said is that they were acquiring new customers, traffic was positive, comps were improving. So there was a lot of positive sentiment that was driving the stock up. But then last night, this was the first full quarter that we got to see the impact after the campaigns. And you know what? It was all Aerie that drove that growth.
Is it possible people are going into American Eagle? That's what you're talking about, right? I get all these names confused. Because they see the denim campaign and then they just leave with the pajamas instead?
Absolutely. I mean, that's something that we know for sure is happening after, like, part of this is making American Eagle relevant again, right? And it's making the brand at the center of conversation, the center of culture. And so consumers are now thinking about American Eagle. They're going into the store and then they see Aerie and they're like, hey, I need a new pair of $60 pajamas. And they're buying.
So what's going on with Levi's in the meantime?
So Levi's really kind of started all of this. They got lucky. Beyonce named a song after them, Levi's jeans, last year. And of course, then they had this huge marketing campaign with them. And then Levi's created denim, right? And then you saw this pattern that has been repeating itself for the last 150 years, ever since Levi created denim, is that competitors race to catch up. So a year later, you had Gap with their Cat's Eye milkshake ad that went totally viral. You had American Eagle with Sydney Sweeney. So they're all chasing that same kind of denim customer, racing to catch up with Levi.
But Levi's is winning as far as you're concerned.
I mean, if you're looking at what the data shows, Levi, it's a landslide. It's kind of hard to compete with them, but there's a lot of room for everybody to win in this environment.
Gabrielle with the info we all needed in the denim wars today. Thank you.
Thank you.
Let's quickly get to Capitol Hill. NVIDIA CEO Jensen Huang about to meet with Senate Banking Committee.
American leadership is really important, and so we have to work together to ensure national security, that we can lead technologically around the world and have the world build on American technology.
Any concerns about your chips going to China?
Of course there is, and we have to ensure that the United States has the best technology at all times, but that United States technology industry can continue to serve the world and win markets around the world.
Are you worried about competition from Google?
There are a number of China hawks who are.
We have lots of competition from a lot of different places.
There are a number of China hawks. There are a number of China hawks who are very concerned that if their chips are being able to go to China and other countries, that's really going to compromise U.S. security. What's your message to them?
We have to ensure national security. Remember, China makes plenty of chips, and their military has plenty of ample chips and bought Chinese chips to build whatever they need. We need to ensure America can continue to win the technology leadership position around the world.
How do you feel about the GAIN AI Act being stripped from both chambers' version of the NDAA?
I'm sorry?
The GAIN AI Act, how do you feel that both versions have been stripped from the NDAA now?
I think that's wise, because the GAIN AI Act is even more detrimental to the United States than the AI Diffusion Act.
Does there need to be some degree, though, of protection on advanced chips that NVIDIA and others produce? Maybe not as something as extreme as the GAIN AI Act, but something within that vein?
We support export control, and we believe that the United States should have the best technology all the time.
Do you think there should be federal regulations on AI, or would you prefer state by state? Obviously, that's the president wants to see federal regulations as opposed to individual states. What's your take on it?
State by state AI regulation would drag this industry into a halt, and it would create a national security concern, as we need to make sure that the United States advances AI technology as quickly as possible. A federal AI regulation is the wisest.
Do you plan on talking to the senators about the H200 chip going to China?
No, we're going to talk about AI industry, AI technology, and its implication on national security, on the economy, and on technology leadership around the world in general.
Why do you think Congress tends to be more pro-export controls and more against some of your positions than the administration?
I'm in favor of export control, and the administration is in favor of export control. We're also all in favor of ensuring that the United States has the best technology and that the United States leads technology around the world.
So how do you make sure the U.S. does have the best technology then? Like, if not with the controls and some of the stuff that's gone with GAIN AI, how do you really make sure that the U.S. is the one delivering and that other countries aren't stealing our information?
The fact of the matter is the industry has done that naturally all by itself. We work very closely with American technology companies, of course, the Microsofts, the AWSs, the Googles, XAI, Meta, all of these companies are American technology companies that we work very closely with. And so it's very natural for us to design and to launch our latest generation, our most advanced technology with American companies first.
About those Blackwell chips, are you currently speaking with the president or anyone else in the administration about getting those Blackwell chips exported to China currently?
No.
How about H200 from the White House? Are you speaking with the White House on H200?
We're talking to the White House all the time about export controls and what's the best way to ensure that we have national security and that we can have technology leadership.
Are you meeting with President Trump today?
Sorry.
Who else are you meeting with today?
The
Are you meeting with the president?
I just met the president.
You just met with President Trump?
Yes.
And what did you discuss? Was there any agreement that came out of that meeting?
We talked in general about export controls, and I wish them happy holidays.
One more on export controls. Do you think that China should have the same access to the same types of chips made in the U.S. as the United States does?
I've said repeatedly that we support export control, that we should ensure that American companies have the best and the most and first.
Does that mean they have inferior chips in China, though?
No. It just means that we have the first and the best at all times. However, we need to be able to compete around the world. The one thing we can't do is we can't degrade chips that we sell to China. They won't accept that. There's a reason why they won't accept that. And so we should offer the most competitive chips we can to the Chinese market.
Would China accept H200? Would they accept H200? Do you think they would?
We don't know.
You said that Gen AI was unwise. Senator Ricketts has a different bill that would codify the current export controls into law and not allow it to go up. Do you think that's also unwise?
The current situation ensures that China and the United States agree on one thing, that no American AI chips can go to China. And I think that that's the worst case condition and is deeply unwise.
Sir, moments ago, Senator Warren criticizing you for
any more announcements?
Okay, Emily, there's a couple. Emily, in front of the camera. Okay. You're going to vamp. Everything he just said.
Okay, cool.
All right, that was Jensen Huang, the CEO of NVIDIA. You saw Emily Wilkins there getting into position to kind of wrap up what we just heard. Jensen Huang, the CEO of NVIDIA, arguably one of, if not the most powerful people in AI in the world, speaking on Capitol Hill. Reporters asking questions about chip sales to China, national security, and more. Welcome, everybody, to Power Lunch. I am Brian Sullivan. Kelly made her way in as well from the exchange. You can see a live exchange between Jensen Huang and others. I know we've got Emily Wilkins sort of getting into position right now in the bowels of Capitol Hill. We also have a big story potentially around Microsoft. A big report this morning suggesting they may be pulling back on some of their AI sales targets, but we did our own reporting and Microsoft pushing back on that report saying, no, maybe not true. Steve Kovac did that. He's going to be here in just a moment. You can see Microsoft stock down just about 2%. Overall, though, the markets in general, they are shrugging off any weaker jobs data that we had from the ADP private sector report. We'll get more insight into the economy as well. Stocks are up for the 7th day in the last 8. Pretty nice little run, just off record highs as well. And David Steinberg, the CEO of Zeta Global, will join us with their newest monthly Zeta Economic Index. We colloquially call it the Zeta Data. Welcome, everybody. A lot going on. Kelly Evans, I just saw you on the 1 o'clock show. Interesting transition.
I think you're right to point out we have stocks at new highs for the session right now, for 457 points on the Dow. So the early anxiety that we had about whatever's going on with the demand picture on some of these AI products is definitely being left a little bit by the wayside. That said, Microsoft shares are still under a little bit of pressure. I know Steve Kovac has been digging into this to kind of bring us a little bit more of what the story looks like as we head into these afternoon hours.
Yeah, we'll get to Steve in just a minute, but right now we got to go back down to Washington, D.C. with Emily Wilkins in literally a hallway underneath Capitol Hill, where, Emily, we saw you and others kind of doorstepping, industry term, Jensen Huang of NVIDIA. A lot of questions about chip sales to China and national security. What were some of the takeaways?
So, Brian, I think some of the big takeaways, first of all, Jensen Huang's doing the rounds today in D.C. He said he did meet with President Trump to talk about export controls. We understand he also met with Speaker of the House Mike Johnson, is now, of course, meeting with Senate Republicans. And he did basically say that he is in support of export controls, but he thinks to a large degree the industry has already made sure that the high-level, high-tech chips are able to stay in the U.S. He talked a little bit, kind of pushing back against what we've heard from some of the China hawks who really want to see stricter limits on what U.S. chips are going to China and other countries. He also did speak a bit about state AI. There's been that debate whether there should be a federal standard to preempt state laws. And Huang said, yes, there should. He thinks that that's sort of the better way to go about doing that, very much in line, of course, with what the AI industry is saying. And of course, this comes at a time where Congress really is in a debate between a lot of the China hawks as well as others. It's trying to figure out exactly what the line should be when it comes to semiconductors. Guys?
All right, Emily Wilkins in Washington, D.C. Emily, thank you very much. We got Dan Niles of Niles Investment Management with us as well. And Dan, thank you for joining us. We're going to talk about Microsoft with Steve Kovac in just a minute based on, this was going to be, by the way, the Microsoft stuff, our top of the show, as we call it, our lead in industry parlance. But when you got Jensen Huang making off-the-cuff comments to Emily Wilkins on Capitol Hill, we got to lead with that. Anything that you may have heard from Huang or anything recently that you have heard from him and NVIDIA that changes your thesis on the AI game?
No. I mean,
well, thanks for coming on.
So I think our interview is done. No, there's nothing that he's saying that he hasn't said in the past. And quite honestly, what he has to say right now, if they get the license to ship to China, obviously that's going to be very good for them. But that doesn't get you away from the biggest thing that Wall Street's wrestling with regards to AI.
Do you believe, let me back it, sorry, Dan, let me back that up for a second, then I want to hear your thoughts. Do you believe, and we have seen Jensen Huang, I was only half joking with the team this morning, Kelly, when I said, who's running NVIDIA? Because Jensen Huang is on Capitol Hill or in China, he's flying all over the world. Do you believe that this charm offensive, particularly with the man in the White House, Donald J. Trump, is designed to obviously help NVIDIA, but realistically open that door to more advanced chip sales to China?
Well, obviously, right? That's the reason to do this. I think the bigger thing that potentially opens the door to China is the fact that China's making lots of advances on AI without any of our chips, right? Because Huawei is shipping Ascend chips. You've got DeepSeek, which is continuing to put out models that are very, very good for open source. And in certain sectors like energy or open source models, China's actually ahead of the US. Now, we have the best hardware in the world. We have the best private AI in the world. But I think when you step back and you say, look, they're making advances with or without us, why don't we at least try to get them to use our chips so that we at least have some control over this? I think that is the right policy going forward, because much like you can think of foundry, right? The US used to lead with Intel in foundries. Now who's the leader? It's TSMC by far. And so you're going to see technology migrate regardless of what you're trying to do to restrict that. And we've already seen that with AI.
Yeah. I'm curious, Dan, as you we were talking this last hour, is it possible that the rising AI tide lifts all boats? I mean, do you have any concerns about Microsoft versus OpenAI and NVIDIA versus Google and all of the stuff? I mean, are you investing as a group, or do you get to the point at which you look for any opportunities to short or do anything like that?
I've been saying this for months, Kelly, which is the market has, up until about a month ago, assumed that every company won in AI. And if you look back at history, and I've said this multiple times, that's not the way it works with, let's take the internet, for example, right? You had a great internet bubble. Coming out of that, how many winners have you really had in e-commerce? One, Amazon. What about in search? Well, you don't hear about Netscape or Yahoo or AOL anymore. It's Google. What about in social? How many winners do you have there? It's really only Meta. Up until about a month ago, it was assumed everybody's going to win. But that's probably not going to be the case. You'll probably have Google win in consumer AI for the simple reason that they've got more training data with 9 products with over 1 billion users each that they can train on. And they've already got the whole vertical stack from ASICs They don't need NVIDIA chips as much as others, all the way through to monetizing it through search, all the way through to products with their Pixel phones and the Android ecosystem.
Yeah.
They're probably going to win there, not OpenAI. So anybody who's exposed to OpenAI, I don't think, and I've said this multiple times over months, I don't think OpenAI can meet that 1.4 trillion infrastructure spend that they have out there, because they're not going to win in consumer AI. And then on the corporate side, right, you've got Microsoft, which obviously, most corporations have Office. I'm guessing you guys do as well. And so they can sell you products through that. But
they've already got the
Office,
installed base, I think is the lingo. Microsoft already has us. Google already has us. Meta probably already has us through Facebook. And OpenAI is coming at it. They're a newer company, kind of secretive. By the way, Sam Altman, welcome on this program. Anytime, anywhere, whatever. And I get your point. And a lot of people besides you, Dan, have privately talked to me about their concerns around OpenAI and this. They're handing out gigawatts of electricity like Oprah's handing out Buicks on a TV show. And it's just not sure that she did it. It's not clear they can do it. I want to go back to Microsoft. Our top story today was going to be this report from the paid research site, The Information, that Microsoft had cut its sales growth targets on AI. They spoke to Steve Kovac. They basically said the report's either not true or misleading. They did something else. It didn't seem to be as serious as the headline. Forget about the report. Microsoft stock fell about 2% on that news. Does that show you or not some of the fragility that may be around this market and the AI trade?
Well, yeah, absolutely. Because let's look at a different stock. Let's look at Oracle, right? Oracle on September 9th reported revenues up, or remaining performance obligations up 359%. The stock on September 9th was at $242. It then went up 36% the next day, the biggest move in history for any company with the market cap over $500 billion. It is now 15% below where it was before they announced their earnings. So if this was about, earnings, you wouldn't have that happening in Oracle. The reason is that out of the $455 billion in RPO announced, $300 billion was from OpenAI. And to your point, Brian, who owns the largest percentage of OpenAI? Microsoft. They have 27% equity ownership. On top of that, they have a revenue share. On top of that, OpenAI runs on top of Azure. So that's the real problem. If you don't believe in OpenAI longer term, then you have to go, well, how's this going to affect Microsoft in the future, even though they have a hammerlock, obviously, on all of us that have companies. So that, to your point, speaks on how difficult it is right now, because the market's starting to go, you know what, everybody is not going to win. And so I need to start differentiating between the Google complex of companies and the OpenAI complex of companies and go, how many winners are there actually going to be? Maybe there's 2 or 3. It's not going to be 10. And that's why this market feels fragile, because as investors are shorting that out, and that's why Microsoft's almost down 2% still today. And Google, by the way, is almost up 2% today.
What's your best idea, Dan, if I could put it that way, in the midst of all this?
Cash. But,
Cash,
being broadly diversified, and I've said this for a while, I think is the best thing. Now, if you're asking, Kelly, within tech.
No, I'm asking broadly. I mean, but go at both, and especially at a moment when there's a lot of enthusiasm actually about the market into next year that I'm hearing. But so you mentioned Google and tech, though.
Yeah, I mean, Google and tech, you can pick Apple because despite the fact they don't have a particularly great product, it doesn't have AI. Next year, you're going to have a good product with AI on those systems. And you're going to have a foldable phone, where Samsung's had one since, I think, 2019 or so. And so that's potentially interesting. But I think if you step back from this, the market's been driven by 2 things for the last 3 years. It's been easy money, the Fed cutting rates, right? The second one has been AI. Well, easy money is pretty much gone after December 10th, because even if you do get a rate cut, which I think you will, you're probably going to get 4 dissents. And there's probably no more rate cuts until May, when President Trump appoints a new head of the Federal Reserve. that's, I think, a problem for markets, because why did this market rip over the last, several days? It's because when you had John Williams from the Fed come out and say, hey, I support a rate cut, the markets that Friday went from a 30% probability of a December cut to 70, and now it's near 90. That's why the market's gone up. But you're not going to get any more rate cuts probably for another 5 months.
So you're saying this, and because Apple is up 41% in 6 months. So you're suggesting, or not suggesting, you're just saying it outright, that this market rally is the rate cut rally 6 to 9 months ahead of time.
Yeah, and the other thing is that, the other part of this is that the AI trade, as we've talked about, right, the market's within 1% of all-time record highs. I think there's almost 5 stocks now. Tesla's like down 9% from its 52-week high, but they're down 10% or so out of the Magnificent Seven from their 52-week highs. And so you're seeing the market broadening to other sectors that you don't have this, failure point with one company, and if there's a problem there, the entire sector potentially gets taken down. You're seeing the market broaden to those other sectors that for the last 3 years people have forgotten about because it's been AI 24/7 on, everybody's lips. And now I think you have to start thinking a little bit more. So if you're concerned that December 10th might be the top because that's the last rate cut for 5 months, other than being broadly diversified, cash is not a bad option. So it's just stuff to think about. And being in these AI trades, as Sam Altman on Monday said, we're at code red. That doesn't necessarily make you feel good that this AI trade is coming back anytime soon, especially after NVIDIA put up a great quarter, great outlook, and the stock went down, I think, 1% last week with the S&P up 4, the Magnificent Seven up 5, and it's obviously struggling again to some degree now with, this Microsoft news. And yeah, it looks like NVIDIA's down a little bit today too.
Dan Niles Investment Management, one of the best in the biz, also pretty good on TV, because you just rolled with a whole new open and intro and show lead. We appreciate it, Dan. Thank you very much.
Thanks, Brian. Thanks, Kelly.
All right. Coming up, we'll get back on track. What is more important for the markets? Is it rate cuts or is it AI? We kind of talked to Dan about it. We've got Scott Croner of Citi on set. Talk about that and more next.
Welcome back. We're either shrugging off the weak data or we're rallying because of it, Brian, in one of these kind of guaranteed lower rates kinds of trades. ADP said we dropped 32K jobs in November. We don't like that. It's the biggest drop since March of 2023. And the Fed decision is a week from today. So how is that setting up things for equities from here? As of now, according to the CME Fed Watch tool, the odds are 89% the Fed will cut a quarter point next week. 0% for a half-point cut, but we are asking the question. Let's see if Scott Kroner would be tiptoeing into that camp at all. He's U.S. equity strategist at Citi. It's great to have you here.
Great being here.
Do we get to the point at which, so we just spoke with Dan Niles, who said, no, the lower rates trade is in the books for now. A lot of people disagree, and I wonder if you're one of them. Do you think lower rates are a significant reason into next year why equities could keep rallying or not?
So I think if you look at where the 10-year's gone over the past 12 trading sessions or 12 days versus where the S&P rally has taken us, they've gone hand in hand, right? So essentially, my view is, and you saw the probabilities on this next Fed rate cut decision, I think the market's telling you 25 basis points is coming. A lot of that's just been priced in. Okay, so from here you get anything incremental is going to be that traditional year-end sentiment boost. But I think from a fundamental perspective, the market's doing just what it should be doing in terms of how it's responding to the changing Fed expectations.
So what do you see for 2026?
So I see for 2026, we haven't published our full year outlook yet. We've been in print for some time, 6,900 mid-year with a bull case around that, closer to 7,700. So color us structurally bullish on U.S. equities from here, okay? But we have to allow that within that, there's going to be a lot of volatility as we see the AI narrative and the broader economic narrative continue to play out, right? This isn't going to be a straightforward path. Fundamentally, though, we think the S&P 500 is in very good shape. Combination of, again, AI tailwinds, but a broadening influence that we've been advocating for several months now.
You've got a pretty big gap between your base case, we're talking about the end of June, so first half next year. 6,900 base case, bull case 7,700. That's 800 points on the S&P. That's a lot of percent. What's the difference between the base case and the bull case? And please don't say 800 points.
How much do you want to pay for it, Brian? Okay, so essentially you're sitting in my seat and you're projecting out. We're at valuations that are near record highs, right? So to sit there and say the valuations are going to go even higher from here, that begins to take you into that boom bubble risk component, right? We don't want to go there. So what we want to focus on is like this presumption that valuations can hold and maybe even come in as earnings growth comes up, right? But the differentiating point here is that from our perspective, what's happening fundamentally is something that we don't usually see this time of the year. This time of the year, you're usually seeing out year numbers come down. This year, we're seeing out year numbers go up.
For earnings.
So
right now in December, we're seeing better and better earnings projections for 2026.
That's correct. So
bottoms up or top down?
Bottom up. So we tend to look at the world, from a bottom up build up perspective, but consensus has now surpassed us. I would have told you 3 months ago, our 308 number for next year was like the second highest in the street.
Wow.
We're at 310 consensus now.
Wow, really?
Yeah, so consensus has come.
That's earnings per share on the S&P 500.
Correct, for 2026. So we're already pricing in a lot of 26 expectation, right? That's been premised in what our year-end 25 target is. But you see where this goes. As you continue to see this earnings lift, that's how you offset valuation concerns. Right. And so essentially where we're going with all of this is, we think that we're in a pretty good position at this point to hold valuations. We have this earnings driver that, again, there's going to be AI influence with the Mag 7 or 8, whichever of those two you want to choose. But the broadening effect is where you're starting to see the rate impact come in. So you look at today's action, you see the banks kicking in. Good news, we're overweight banks. You're seeing the retailers kick in. Good news, we're overweight retailers. We've been trying to position our sector views here to align with where we think Fed rate cuts can come in and begin to give you a new angle from which to drive the index.
Okay, but yesterday, the CFO of Procter & Gamble made some concerning comments about the consumer, said kind of consumers a little shaky, whatever the phrasing was. It was not a bullish commentary on the consumer from P&G, pretty doggone important company.
Right.
So to Kelly's point about earnings, top down, bottoms up, will that earnings growth be spread out across industries, or is it really, again, going to be just concentrated in the same freaking 20 companies?
It's going to broaden. Okay, and it's going to broaden down a sector path, and it may even broaden down an asset class path. We may be talking about the small mid-cap part of the market, which is coming off of a 2-year earnings recession, actually, potentially driving earnings growth next year that's going to approximate where the S&P is going to go. So you got a couple of things going on here. You've got, this mega cap growth leadership that's been driving the recent earnings revisions, but what's happening from a sector perspective, you're setting things up here to where you're going to have nearly every sector, in our view, contributing positively to earnings growth next year. That's the broadening effect. And so this is pretty powerful, particularly when you think about where we are with the Fed cycle and the path lower, presumably here for rates. Let's put some gates around where we think the inflation discussion's taken us. But all told, again, you're talking to the guy that's essentially a structural bull on this, because where we haven't even gotten yet, but maybe you have with your holiday shopping in Rufus, where we haven't gotten yet is, okay, we're talking about AI enablers and creators, okay? That's the Mag 7, the Mag 8, mega cap growth cohort. We think next year we're going to get much more idiosyncratic on that cohort of stocks, but importantly, the discussion begins to switch to AI users. So now you got every other company in the marketplace that's now embracing AI technologies. And as a C-suite, you better have an AI strategy. If you don't, you got investors looking cross-eyed at you. So essentially what happens from here is that we think this productivity play really begins to broaden out, supports the fundamental underpinnings, and that's when you can begin to talk about bull versus base cases, Brian.
Man, I love innovation. Don't you? Isn't it just wonderful?
It's so innovative.
Great time to be alive. Thank you, Scott. Really appreciate it.
Great
to
being
have
here.
you
Thank
here.
you.
Scott Cronin.
All right, well, today's weaker than expected ADP jobs data did impact Treasury yields. That report raising some concerns about health of the labor market and maybe the health of the American economy. Rick Sancelli joining us now with more on the bond report, where I suspect you will reference Japan, Rick.
Oh, absolutely. We'll leave the best to the end. Yes, ADP, look at a bar chart of 1 year. Definitely some deterioration. Is it anybody's first choice when the day's all coming in on time? Probably not. But anecdotally, it seems to fit that the labor market is weakening. Just how much? It's kind of hard to tell. Look at a 12-hour chart of 10s. You can clearly see the weak data took its toll early. But then yields turned up briefly. Why? Well, our last guest mentioned it, and I use this chart a lot. Let's put the S&P futures on top of 10-year, and what you'll notice is that as the S&Ps started to rumble higher, it definitely dragged rates along with it. That's happened about 10:20 Eastern, but then it lost steam and it separated again. So you could actually say that the equities pulled rates up, but then the lingering weakness in that jobs data took its toll, and it ultimately is now, as you see, 3 basis points deterioration across all maturities. And finally, this is a chart going back 18 years of Japanese 10-year, another fresh high yield close. Kelly, back to you.
And significant one for the global markets. Rick, thanks. Our market navigator agrees with Michael Burry, who slammed Tesla for being ridiculously overvalued. We'll talk about, you will not believe, frankly, how he's playing the stock. We'll talk about that next. With Tesla's market cap now nearing $1.5 trillion, some people are questioning whether the company is overvalued, and Michael Burry is among them. The Big Short investor writing in a weekend blog post that the company is, quote, ridiculously overvalued. Our next guest has some thoughts on that as well, and he says Tesla faces some serious challenges heading into the new year. Let's bring in Tony Zhang. He's the chief strategist at Options Play. I guess I wouldn't say you're shorting this in options parlance, Tony, but what are you doing exactly for this trade?
Yeah, well, I am taking a bearish position here, and I think the recent rally here to that double top around that 470 level, now that we've seen that the stock has pulled back a little bit, we're starting to see some underperformance relative to the S&P 500. I think the timing on this looks quite strong here to take some bearish exposure. As you said, the stock is ridiculously overvalued, but I think we could argue that for pretty much any time over the last few years that the stock has remained ridiculously overvalued. So I think that itself alone is not necessarily a good reason to take a bearish exposure in this particular stock, but you have to look at the timing on this. And I think the stock starting to underperform here is starting to show some cracks here alongside with the fundamentals really starting to slip here this year with Tesla.
So what's the trade?
Yeah, so I'm looking at going out to the January expiration, and I'm looking at using a put debit spread because options on Tesla right now are incredibly inexpensive. So I think you can buy some downside protection for cheap by using a put spread. So I'm going out to that January expiration. I'm looking at buying a 425 370 put spread. Earlier today, you can pay a little under $17.50 for that debit spread. Right now, with the stock rallying nearly 4% on today's price action, I think you could probably pick it up for even a little bit under $17. This way, you could basically have a nearly 3-to-1 risk to reward ratio if we see a little bit of volatility ahead for the overall markets between now and that January expiration, and we see a bit of a pullback here for Tesla.
All right, I'll be thinking about you if that price action moves to the downside. Tony, thanks for joining us today. Appreciate it. Tony Zhang. Brian?
All right, Kelly, thank you. Coming up, we're going to name names on a little talked about stock that one analyst says could be a hidden AI play that's staring you right in the face. Stick around.